This is Audible.
Gildan Media, a division of Recorded Books, presents Financial Statements, 3rd edition, A Step. The first 2 editions of this book have sold over 200,000 copies. Not as many books as would be expected for a best-selling novel or a famous or infamous politician's memoir, but that is a lot for an accounting text. To keep the book timely, we have updated and expanded this new 3rd edition. I've gotten older and wiser in the 20 years since the first edition was published, and I've tried to add some of that wisdom to this new edition. Of particular interest is the addition of a discussion of pricing theory. Pricing is more than just guessing, trial and error, or following an old rule of thumb. This section introduces profit maximization pricing theory based on the use of price-volume curves. Appleseed Enterprises Incorporated's applesauce price deliberations are described. The 2 new appendices have been added at the back of the book. Appendix C, Non-Profit Accounting. Non-profit accounting has a different focus than its for-profit cousin. Profit is less important, no taxes to collect, but demonstrating how charitable donations are spent in furtherance of public mission is of great importance. Revenue generation and cost and expense reporting is of interest too. It is documented and available for all, that is, the public and the government, to see. Appendix E, Debits and Credits. Back in the olden days, when systematic accounting and statement presentation was first developed, the monks would write down each and every transaction as they occurred. The concept of debits and credits was invented to structure A, the layout of accounting journal and ledger books for everyone to understand, B, to aid the monks in classifying and recording transactions properly, and C, to catch manual transcribing errors. Today we use computers, and I have not used the debit and credit concepts in this book. They are confusing for non-financial managers. However, since accountants still rely on this double-entry system when they discuss the company's books and financial statements, it is good for you to have a basic understanding of what they mean. Also, added at the end of the index are suggestions for further reading. The Internet revolution has made relevant accounting and finance information easily accessible at all levels. In this section, we have listed the best sources for more details for topics introduced in this basic text. Online exploring can be fun and informative. Enjoy the experience. If you have questions or comments, please contact me. I'll be happy to hear from you. My contact information is in About the Author. Preface to the 2nd edition. If the first edition of this book was an entrepreneurial business, it would be a huge success. Now, over 100,000 copies of Financial Statements, a step-by-step guide to understanding and creating financial reports, are in press and helping non-financial managers and students of accounting and finance cope with the numbers of business. With this new revised 2nd edition, we have expanded the book into 5 sections from the original 3. Many readers of the first edition wanted to better understand making capital investment decisions, the focus of our 2 new sections. Capital is often a company's scarcest resource, and using capital wisely is essential for success. The chief determinant of what a company will become in the future is the capital investments it makes today. So, in this new edition, we will use the financial analysis techniques of net present value, NPV, and internal rate of return, IRR, to make investment decisions. Preface to the first edition. We needed to hire an accountant to keep the books at our venture capital-backed high-technology startup of which I was a founder and CEO. I interviewed a young woman just out of school for the job and asked her why she wanted to become an accountant. Her answer was a surprise to all of us. Because accounting is so symmetrical, so logical, so beautiful, and it always comes out right, she said. We hired her on the spot, thinking it would be fun to have almost a poet keeping our books. She worked out fine. I hope you take away from this book a part of what my young accountant saw. Knowing a little accounting and financial reporting can be very satisfying. Yes, it does all come out right at the end, and there is real beauty and poetry in its structure. But let's discuss, perhaps, the real reason you've bought and are now listening to this book. My bet is that it has to do with power. You want the power you see associated with knowing how numbers flow in business. Be it poetry or power, this accounting and financial reporting stuff is not rocket science. You've learned all the math required to master accounting by the end of the 4th grade, mostly addition and subtraction, with a bit of multiplication and division thrown in to keep it lively. The specialized vocabulary, on the other hand, can be confusing. You will need to learn the accounting definitions of revenue, income, cost, and expense. You'll also need to understand the structure and appreciate the purpose of the 3 major numeric statements that describe a company's financial condition. Here's a hint. Watch where the money flows. Watch where goods and services go. Documenting these movements of cash and product is all that financial statements do. It is no more complicated than that. Everything else is details. But why is it all so boring, you ask? Well, it's only boring if you do not understand it. Yes, the day-to-day, repetitive accounting tasks are boring. However, how to finance and extract cash from the actions of the enterprise is not boring at all. It is the essence of business and the generation of wealth. Not boring at all. Thomas Ittelson, Cambridge, Massachusetts. Introduction. Many non-financial managers have an accounting phobia, a financial vertigo that limits their effectiveness. If you think inventory turn means rotating stock on the shelf, and that accrual has something to do with the Wicked Witch of the West, then this book is for you. Financial Statements, a step-by-step guide to understanding and creating financial reports, is designed for those business professionals A, who know very little about accounting and financial statements but feel they should, and those B, who need to know a little more but for whom the normal accounting and financial reporting texts are mysterious and unenlightening. In fact, the 2 categories make up the majority of all people in business. You are by no means alone. Financial Statements, a step-by-step guide to understanding and creating financial reports, is a transaction-based business training tool with clarifying and straightforward real-life examples of how financial statements are built and how they interact to present a true financial picture of the enterprise. We will not get bogged down in details that get in the way of conceptual understanding. Just as it is not necessary to know how the microchips in your computer work to multiply a few numbers, it's not necessary to be a CPA, certified public accountant, to have a working knowledge of the accounting model of the enterprise. Transactions. This book describes a sequence of transactions of our sample company, Appleseed Enterprises Incorporated, as it goes about making and selling delicious applesauce. We will sell stock to raise money, buy machinery to make our product, and then satisfy our customers by shipping wholesome applesauce. We'll get paid, and we will hope to make a profit. Then we will expand the business. Each step along the way will generate account postings on Appleseed's books. We'll discuss each transaction to get a hands-on feel for how a company's financial statements are constructed. We'll learn how to report using the 3 main financial statements of a business: the balance sheet, income statement, and cash flow statement, for these common business dealings. 1. Selling stock. 2. Borrowing money. 3. Receiving orders. 4. Shipping goods. 5. Invoicing customers. 6. Receiving payments. 7. Paying sales commissions. 8. Writing off bad debts. 9. Prepaying expenses. 10. Ordering equipment. 11. Paying deposits. 12. Receiving raw materials. 13. Scrapping damaged product. 14. Paying suppliers. 15. Booking manufacturing variances. 16. Depreciating fixed assets. 17. Valuing inventory. 18. Hiring staff and paying salary, wages, and payroll taxes. 19. Computing profit. 20. Paying income taxes. 21. Issuing dividends. 22. Acquiring a business. 23. And more. By the end of this book, you'll know your way around the finances of our applesauce-making company, Appleseed Enterprises Incorporated. Goals. My goal in writing this book is to help people in business master the basics of accounting and financial reporting. This book is especially directed at all those managers, scientists, salespeople who should know how a balance sheet, income statement, and cash flow statement work, but don't. Your goal here is to gain knowledge of accounting and finance to assist you in your business dealings. You want the power that comes from understanding financial manipulations. You must know how the score is kept in business. You recognize, as Gordon Beatty says, that you must feel intuitively comfortable with the accounting model to succeed in business. This book is divided into 5 main sections, each with a specific teaching objective. Section A, Financial Statements, Structure and Vocabulary, will introduce the 3 main financial statements of the enterprise and define the special vocabulary that is necessary to understand the books and to converse with accountants. Section B, Transactions, Exploits of Appleseed Enterprises Incorporated, will take us through 31 business transactions, showing how to report the financial impact of each on the balance sheet, income statement, and cash flow statement of Appleseed Enterprises. Section C, Financial Statements, Construction and Analysis, will subject the financial statement of our sample company to a rigorous analysis using common ratio analysis techniques. Then, finally, we will touch on how to cook the books, why someone would want to, and how to detect financial fraud. Section D, Business Expansion, Strategy, Risk, and Capital, will describe the strategic decisions that a fledgling company must make when it expands. We will answer the question, where will we get the money and how much will it cost? Then, in Section E, Making Good Capital Investment Decisions, we will analyze business expansion alternatives and select the best using sophisticated net present value, NPV, techniques. Then, the appendices will be fun. We will discuss A. Business fraud and speculative bubbles. B. The value difference between having $1 today and $1 tomorrow. C. The differences between accounting methods for traditional for-profit companies and for nonprofit organizations. And finally, D. The medieval concept of debits and credits. With your newly acquired understanding of the structure and flow of money in business, you will appreciate these important business quandaries. How an enterprise can be rapidly growing, highly profitable, and out of money all at the same time, and why this state of affairs is fairly common. Why working capital is so very important, and which management actions lead to more, which lead to less. The difference between cash in the bank and profit on the bottom line and how the two are interrelated. When in the course of business affairs a negative cash flow is a sign of good things happening and when it's a sign of impending catastrophe. Limits of common costing systems and when to apply, and more importantly, when to ignore, the accountant's definition of cost. Why a development investment made today must return a much greater sum to the coffers of the company in later years. How discounts drop right to the bottom line as lost profits, and why they are so very dangerous to a company's financial health. how risk is different than uncertainty and which is worse, why $1 in your pocket today can be worth a lot more than $1 received tomorrow, the necessity and limitation of forecasting cash flows over time when making capital investment decisions, when to use NPV analysis and when to use IRR, and why it is important in capital investment decision-making. To be effective in business, you must understand accounting and financial reporting. Don't become an accountant, but do speak the language and become intuitively comfortable with the accounting model of the enterprise. Listen on. Accounting is a language, a means of communicating among all the segments of the business community. It assumes a reference base called the accounting model of the enterprise. While other models of the enterprise are possible, this accounting model is the accepted form and is likely to be for some time. If you don't speak the language of accounting or feel intuitively comfortable with the accounting model, you will be at a severe disadvantage in the business world. Accounting is a fundamental tool of the trade. Gordon B. Beatty, Entrepreneurship, Prentice Hall, Englewood Cliffs, New Jersey, 1990. Even if it's boring and dull and soon to be forgotten, continue to learn double-entry bookkeeping. People think I'm joking, but I'm not. You should love the mathematics of business. Kenneth H. Olson, entrepreneurial founder of Digital Equipment Corporation. Section A. Financial Statement Structure and Vocabulary. About this section. This book is written for people who need to use financial statements in their work, but have no formal training in accounting and financial reporting. Don't feel bad if you fall into this category. My guess is that 95% of all non-financial managers are financially illiterate when it comes to understanding the company's books. Let's proceed toward some enlightenment. This section is about financial statement structure and about the specialized vocabulary of financial reporting. We will learn both together. It's easier that way. Much of what passes as complexity in accounting and financial reporting is just A. specialized and sometimes counterintuitive vocabulary, and B. basically simple reporting structure that gets confusing only in the details. Vocabulary. In accounting, some important words may have meanings that are different from what you would think as a non-financial person. It is absolutely essential to use these words correctly when discussing financial statements. You'll just have to learn them. It's really not that much, but it is important. Examples. 1. Sales and revenue are synonymous and mean the top line of the income statement, the money that comes in from customers. 2. Profits, earnings, and income are all synonymous and mean the bottom line, or what is left over from revenue after all the costs and expenses spent in generating that revenue are subtracted. Note that revenue and income have different meanings. Revenue is the top line, and income is the bottom line of the income statement. 3. Costs are money, mostly for materials and labor, spent making a product. Expenses are money spent to develop it, sell it, account for it, and manage this whole making and selling process. 4. Both costs and expenses become expenditures when money is actually sent to vendors to pay for them. 5. Orders are placed by customers and signify a request for the future delivery of products. Orders do not have an impact on any of the financial statements in any way until the products are actually shipped. At this point, these shipments become sales. The words shipments and sales are synonymous. 6. Solvency means having enough money in the bank to pay your bills. Profitability means that your sales are greater than your costs and expenses. You can be profitable and insolvent at the same time. You are making money but still do not have enough cash to pay your bills. Financial statements. Once you understand the specialized accounting vocabulary, you can appreciate financial statement structure. In the following 3 chapters, we will learn both together the 3 main financial statements: the balance sheet, the income statement, and the cash flow statement. To end the section, we will discuss how these 3 statements interact and when changing a number in one necessitates changing a number in another. Chapter 1 will lay some ground rules for financial reporting, starting points and assumptions that accounting professionals require to let them make sense of a company's books. In Chapter 2, we will discuss the balance sheet, what you own and what you owe. Then, in Chapter 3 comes the income statement, reporting on the enterprise's product-selling activities and whether there is any money left over after all these operations are done and accounted for. The last statement, but often the most important in the short term, is the cash flow statement, discussed in Chapter 4. Look at this statement as a simple check register with deposits being cash in and any payments cash out. Chapter 5 will put all 3 financial statements together and shows how they work in concert to give a true picture of the enterprise's financial health. Sales and revenue mean the same thing. Profit, earnings, and income mean the same thing. Now, revenue and income do not mean the same thing. Costs are different from expenses. Expenses are different from expenditures. Sales are different from orders, but are the same as shipments. Profits are different from cash. Solvency is different from profitability. Chapter 1. 12 Basic Principles. Accountants have some basic rules and assumptions upon which rest all their work in preparing financial statements. These accounting rules and assumptions dictate what financial items to measure and when and how to measure them. By the end of this discussion, you will see how necessary these rules and assumptions are to accounting and financial reporting. So, here are the 12 very important accounting principles. 1. Accounting entity. 2. Going concern. 3. Measurement. 4. Units of measure. 5. Historical cost. 6. Materiality. 7. Estimates and judgments. 8. Consistency. 9. Conservatism. 10. Periodicity. 11. Substance over form. 12. Accrual basis of presentation. These rules and assumptions define and qualify all that accountants do and all that financial reporting reports. We will deal with each in turn. 1. Accounting entity. The accounting entity is the business unit, regardless of the legal business form, for which the financial statements are being prepared. The accounting entity principle states that there is a business entity separate from its owners, a fictional person called a company for which the books are written. 2. Going concern. Unless there is evidence to the contrary, accountants assume that the life of the business entity is infinitely long. Obviously, this assumption cannot be verified and is hardly ever true. But this assumption does greatly simplify the presentation of the financial position of the firm and aids in the preparation of financial statements. If, during the review of a corporation's books, the accountant has reason to believe that the company may go bankrupt, he must issue a qualified opinion stating the potential of the company's demise. More on this concept later. 3. Measurement. Accounting deals with things that can be quantified, resources and obligations upon which there is an agreed-upon value. Accounting only deals with things that can be measured. This measurement assumption leaves out many very valuable company assets. For example, loyal customers, while necessary for company success, still cannot be quantified and assigned a value, and thus are not stated in the books. Financial statements contain only the quantifiable estimates of assets, what the business owns, and liabilities, what the business owes. The difference between the two equals owner's equity. 4. Units of measure. U.S. dollars are the units of value reported in the financial statements of U.S. companies. Results of any foreign subsidiaries are translated into dollars for consolidated reporting of results. As exchange rates vary, so do the values of any assets and liabilities denominated in foreign currency. 5. Historical cost. What a company owns and what it owes are recorded at their original historical cost, with no adjustment for inflation. A company can own a building valued at $50 million, yet carry it on the books at its $5 million original purchase price, less accumulated depreciation, a gross understatement of value. This assumption can greatly understate the value of some assets purchased in the past and depreciated to a very low amount on the books. Why, you ask, do accountants demand that we obviously understate assets? Basically, it is the easiest thing to do. You do not have to appraise and reappraise all the time. 6. Materiality. Materiality refers to the relative importance of different financial information. Accountants don't sweat the small stuff, but all transactions must be reported if they would materially affect the financial condition of the company. Remember, what is material for a corner drugstore is not material for IBM, lost in the rounding errors. Materiality is a straightforward judgment call. 7. Estimates and judgments. Complexity and uncertainty make any measurement less than exact. Estimates and judgments must often be made for financial reporting. It is okay to guess if A, that is the best you can do, and B, the expected error would not matter much anyway. But accountants should use the same guessing method for each period. Be consistent in your guesses and do the best you can. 8. Consistency. Sometimes identical transactions can be accounted for differently. You could do it this way or that way, depending upon some preference. The principle of consistency states that each individual enterprise must choose a single method of reporting and use it consistently over time. You cannot switch back and forth. Measurement techniques must be consistent from any one fiscal period to another. 9. Conservatism. Accountants have a downward measurement bias, preferring understatement to overvaluation. For example, losses are recorded when you feel that they have a great probability of occurring, not later when they actually do occur. Conversely, the recording of a gain is postponed until it actually happens, not when it is only anticipated. 10. Periodicity. Accountants assume that the life of a corporation can be divided into periods of time for which profits and losses can be reported, usually a month, quarter, or year. What is so special about a month, quarter, or year? They are just convenient periods, short enough so that management can remember what has happened, long enough to have meaning and not just be random fluctuations. These periods are called fiscal periods. For example, a fiscal year could extend from October 1 in one year till September 30 in the next year, or a company's fiscal year could be the same as the calendar year, starting on January 1 and ending on December 31. 11. Substance over form. Accountants report the economic substance of a transaction rather than just its form. For example, an equipment lease that is really a purchase dressed up in a costume should be booked as a purchase and not just as a lease on financial statements. This substance over form rule states that if it's a duck, then you must report it as a duck. 12. Accrual basis of presentation. This concept is very important to understand. Accountants translate into dollars of profit or loss all the money-making or losing activities that take place during a fiscal period. In accrual accounting, if a business action in a period makes money, then all its product costs and its business expenses should be reported in that period. Otherwise, profits and losses could flop around depending on which period the entries were made. In accrual accounting, this documentation is accomplished by matching for presentation A, the revenue received in selling product, and B, the costs to make that specific product sold. Fiscal period expenses such as selling, legal, administrative, and so forth are then subtracted. Key to accrual accounting is determining A, when you may report a sale on the financial statements, B, matching and then reporting the appropriate costs of products sold, and C, using a systematic and rational method allocating all the other costs of being in business for the period. We will deal with each point separately. Revenue recognition. In accrual accounting, a sale is recorded when all the necessary activities to provide the good or service have been completed, regardless of when cash changes hands. A customer just ordering a product has not yet generated any revenue. Revenue is recorded when the product is shipped. Matching principle. In accrual accounting, the costs associated with making products, costs of goods sold, COGS, are recorded at the same time the matching revenue is recorded. Allocation. Many costs cannot be specifically associated with a product. These costs must be allocated to fiscal periods in a reasonable fashion. For example, each month can be charged with 1/12 of the general business insurance policy, even though the policy was paid in full at the beginning of the year. Other expenses are recorded when they arise, period expenses. Note that all businesses with inventory must use the accrual basis of accounting. Other businesses may use a cash basis if they desire. Cash basis financial statements are just like the cash flow statement or a simple checkbook. We'll describe features of accrual accounting in the chapters that follow. Who makes all these rules? The simple answer is that FASB makes the rules, and they are called GAAP. Note also that FASB is made up of CPAs. Got that? Financial statements in the United States must be prepared according to the accounting profession's set of rules and guiding principles, called the Generally Accepted Accounting Principles, GAAP for short. Other countries use different rules. GAAP is a series of conventions, rules, and procedures for preparing and reporting financial statements. The Financial Accounting Standards Board, FASB for short, lays out the GAAP conventions, rules, and procedures. The FASB's mission is to establish and improve standards of financial accounting and reporting for guidance and education of the public, including issuers, auditors, and users of financial information. The Securities and Exchange Commission, SEC, designates FASB as the organization responsible for setting accounting standards for all U.S. public companies. CPAs. CPAs are, of course, certified public accountants. These very exalted individuals are specially trained in college and have practiced auditing companies for a number of years. In addition, they have passed a series of exams testing their clear understanding of both accounting principles and auditing procedures. Note that FASB is made up mostly of CPAs, and that CPAs both develop, interpret, and apply GAAP when they audit a company. All this is fairly incestuous. Single and double lines. Lines are perhaps not as important as principles, but they can be confusing if you don't know how accountants use them in financial statements. Financial statements often have two types of lines to indicate types of numeric computations above and below the lines. Single lines on a financial statement indicate that a calculation, addition or subtraction, has been made on the numbers just preceding in the column. The double underline is saved for the last. That is, use of a double underline signifies the very last amount in the statement. Note that while all the numbers in the statement represent currency, only the top line and the bottom line of the statement normally show a dollar sign. This use is just a convention. Chapter 2. Balance Sheet. One of the two main financial statements of a business. The other is the income statement. The basic equation of accounting. The basic equation of accounting states what you have minus what you owe is what you're worth. Assets, have, minus liabilities, owe, equals worth, value to owners. Worth, net worth, equity, owner's equity, and shareholder's equity all mean the same thing, the value of the enterprise belonging to its owners. The balance sheet. The balance sheet presents the basic equation of accounting in a slightly rearranged form. Assets, have, equals liabilities, owe, plus worth, value to owners. By definition, this equation must always be in balance, with assets equaling the sum of liabilities and worth. So, if you add an asset to the left side of the equation, you must also increase the right side by adding a liability or increasing worth. Two entries are required to keep the equation in balance. The balance sheet, a snapshot in time. The balance sheet presents the financial picture of the enterprise on one particular day, an instant in time, the date it was written. The balance sheet presents what the enterprise has today, assets, how much the enterprise owes today, liabilities, what the enterprise is worth today, equity. The balance sheet reports has today, assets, equals owes today, liabilities, plus worth today, shareholders' equity. What are assets? Assets are everything you've got. Cash in the bank, inventory, machines, buildings, all of it. Assets are also certain rights you own that have a monetary value, like the right to collect cash from customers who owe you money. Assets are valuable, and this value must be quantifiable for an asset to be listed on the balance sheet. Everything in a company's financial statements must be translated into dollars and cents. Grouping assets for presentation. Assets are grouped for presentation on the balance sheet according to their characteristics. Very liquid assets, cash and securities, productive assets, plant and machinery, assets for sale, inventory. Accounts receivable are a special type of asset group, the obligations of customers of a company to pay the company for goods shipped to them on credit. Assets are displayed in the Assets section of the balance sheet in the descending order of liquidity, the ease of convertibility into cash. Cash itself is the most liquid of all assets. Fixed assets are normally the least liquid. Current assets. By definition, current assets are those assets that are expected to be converted into cash in less than 12 months. Current asset groupings are listed in order of liquidity, with the most easy to convert into cash listed first. A. Cash, B. Accounts receivable, C. Inventory, and D. prepaid expenses. Prepaid expenses are a special type of current assets, expenditures for services to be rendered to the company within the next 12 months. The money the company will use to pay its bills in the near term, within the year, will come when its current assets are converted into cash, that is, when inventory is sold, and accounts receivable are then paid to the company by customers. Current assets, cash. Cash is the ultimate liquid asset, on-demand deposits in a bank as well as the dollars and cents in the petty cash drawer. When you write a check to pay a bill, you are taking money out of cash assets. Like all of the rest of the balance sheet, cash is denominated in U.S. dollars for corporations in the United States. A U.S. company with foreign subsidiaries would convert the value of any foreign currency it holds, and also other foreign assets, into dollars for financial reporting. Current assets, accounts receivable. When the enterprise ships a product to a customer on credit, the enterprise acquires a right to collect money from that customer at a specified time in the future. These collection rights are totaled and reported on the balance sheet as accounts receivable. Accounts receivable are owed to the enterprise from customers, called accounts, who were shipped goods but have not yet paid for them. Credit customers, most business between companies is done on credit, are commonly given payment terms that allow 30 or 60 days to pay. Current assets, inventory. Inventory is both finished products for ready sale to customers and also materials to be made into products. A manufacturer's inventory includes three groupings. 1. Raw material inventory is unprocessed materials that will be used in manufacturing products. 2. Work-in-process inventory is partially finished products in the process of being manufactured. 3. Finished goods inventory is completed products ready for shipment to customers when they place orders. As finished goods inventory is sold, it becomes an accounts receivable and then cash when the customer pays. Current assets, prepaid expenses. Prepaid expenses are bills the company has already paid, but for services not yet received. Prepaid expenses are things like prepaid insurance premiums, prepayment of rent, deposits paid to the telephone company, salary advances, etc. Prepaid expenses are current assets not because they can be turned into cash, but because the enterprise will not have to use cash to pay them in the near future. They have been paid already. Current asset cycle. Current assets are said to be working assets because they are in a constant cycle of being converted into cash. More asset types. In addition to a company's current assets, there are two major asset groups listed on the balance sheet: other assets and fixed assets. These so-called non-current assets are not converted into cash during the normal course of business. Other assets is a catch-all category that includes intangible assets such as the value of patents, trade names, and so forth. The company's fixed assets, so-called property, plant, and equipment, or PP&E, is generally the largest and most important non-current asset grouping. Fixed assets at cost. Fixed assets are productive assets not intended for sale. They will be used over and over again to manufacture the product, display it, warehouse it, transport it, and so forth. Fixed assets commonly include land, buildings, machinery, equipment, furniture, automobiles, trucks, etc. Fixed assets at cost are reported on the balance sheet at original purchased price. Fixed assets are also shown as net fixed assets, valued at original cost minus an allowance for depreciation. Accumulated depreciation. Depreciation is an accounting convention reporting on the income statement the decline in useful value of a fixed asset due to wear and tear from use and the passage of time. Depreciating an asset means spreading the cost to acquire the asset over the asset's whole useful life. Accumulated depreciation on the balance sheet is the sum of all the depreciation charges taken since the asset was first acquired. Depreciation charges taken over a period do lower profits for the period, but do not lower cash. Cash was required to purchase the fixed asset originally. Net fixed assets. The net fixed assets of a company are the sum of its fixed assets purchase prices, fixed assets at cost, minus the depreciation charges taken on the income statement over the years, accumulated depreciation. The so-called book value of an asset, its value as reported on the books of the company, is the asset's purchase price minus its accumulated depreciation. Note that depreciation does not necessarily relate to an actual decrease in value. In fact, some assets appreciate in value over time. However, such appreciated assets are, by convention, still reported on the balance sheet at their lower book value. Other assets. The other assets category on the balance sheet includes assets of the enterprise that cannot be properly classified into the current assets or fixed assets categories. Intangible assets, a major type of other assets, are things owned by the company that have value but are not tangible, that is, not physical property in nature. For example, a patent, a copyright, or a brand name can have considerable value to the enterprise, yet these are not tangible as a machine or inventory is. Intangible assets are valued by management according to various accounting conventions too complex, arbitrary, and confusing to be of interest here. What are liabilities? Liabilities are economic obligations of the enterprise, such as money that the corporation owes to lenders, suppliers, employees, etc. Liabilities are categorized and grouped for presentation on the balance sheet by 1. To whom the debt is owed, and 2. Whether the debt is payable within the year, current liabilities, or is a long-term obligation. Shareholders' equity is a special kind of liability. It represents the value of the corporation that belongs to its owners. However, this debt will never be repaid in the normal course of business. Current liabilities. Current liabilities are bills that must be paid within 1 year of the date of the balance sheet. Current liabilities are the reverse of current assets. Current assets provide cash within 12 months. Current liabilities take cash within 12 months. The cash generated from current assets is used to pay current liabilities as they become due. Current liabilities are grouped depending on to whom the debt is owed: A. Accounts payable owed to suppliers, B. Accrued expenses owed to employees and others for services, C. Current debt owed to lenders, and D. Income taxes payable owed to the government. Current liabilities. Accounts payable. Accounts payable are bills, generally to other companies, for materials and equipment bought on credit that the corporation must pay soon. When it receives materials, the corporation can either pay for them immediately with cash or wait and let what is owed become an account payable. Business-to-business transactions are most often done on credit. Common trade payment terms are usually 30 or 60 days with a discount for early payment, such as 2% off if paid within 10 days, or the total due in 30 days, 2% 10, net 30. Current liabilities, accrued expenses. Accrued expenses are monetary obligations similar to accounts payable. The business uses one or the other classification depending on to whom the debt is owed. Accounts payable is used for debts to regular suppliers of merchandise or services bought on credit. Examples of accrued expenses are salaries earned by employees but not yet paid to them, lawyers' bills not yet paid, interest due but not yet paid on bank debt, and so forth. Current debt and long-term debt. Any notes payable and the current portion of long-term debt are both components of current liabilities and are listed on the balance sheet under current portion of debt. If the enterprise owes money to a bank and the terms of the loan say it must be repaid in less than 12 months, then the debt is called a note payable and is a current liability. A loan with an overall term of more than 12 months from the date of the balance sheet is called long-term debt. A mortgage on a building is a common example. The so-called current portion of long-term debt is that amount due for payment within 12 months and is a current liability listed under current portion of debt. Current liabilities, taxes payable. Every time the company sells something and makes a profit on the sale, a percentage of the profit will be owed the government as income taxes. Income taxes payable are income taxes that the company owes the government but that the company has not yet paid. Every 3 months or so, the company will send the government a check for the income taxes owed. For the time between when the profit was made and the time when the taxes are actually paid, the company will show the amount to be paid as income taxes payable on the balance sheet. Working capital. The company's working capital is the amount of money left over after you subtract current liabilities from current assets. The good stuff, current assets, cash, accounts receivable, inventory, prepaid expenses, minus the less good stuff, current liabilities, accounts payable, accrued expenses, current portion of debt, income taxes payable, equals the great stuff, working capital. Working capital is the amount of money the enterprise has to work with in the short term. Working capital feeds the operations of the enterprise with dollar bills. Working capital is also called net current assets or simply funds. Sources and uses of working capital. Sources of working capital are ways working capital increases in the normal course of business. This increase in working capital happens when 1. Current liabilities decrease and/or 2. Current assets increase. Uses of working capital, also called applications, are ways working capital decreases during the normal course of business. For example, when 1. Current assets decrease and/or 2. Current liabilities increase. With lots of working capital, it will be easy to pay your current financial obligations, bills that come due in the next 12 months. Total liabilities. Note, in most balance sheet formats, there is not a separate line for total liabilities. A company's total liabilities are just the sum of its current liabilities and its long-term debt. Long-term debt is any loan to the company to be repaid more than 12 months after the date of the balance sheet. Common types of long-term debt include mortgages for land and buildings and the so-called chattel mortgages for machinery and equipment. Shareholders' equity. If you subtract what the company owes, total liabilities, from what it has, total assets, you are left with the company's value to its owners, its shareholders' equity. Shareholders' equity has 2 components. 1. Capital stock, the original amount of money the owners contributed as their investment in the stock of the company. 2. Retained earnings, all the earnings of the company that have been retained, that is, not paid out as dividends to owners. Note, both net worth and book value mean the same thing as shareholders' equity. Capital stock. The original money to start and any add-on money invested in the business is represented by shares of capital stock held by owners of the enterprise. Common stock is the regular denomination of ownership for all corporations. All companies issue common stock, but they may issue other kinds of stock too. Companies often issue preferred stock that have certain contractual rights or preferences over the common stock. These rights may include a specified dividend and/or a preference over common stock to receive company assets if the company is liquidated. Retained earnings. All the company's profits that have not been returned to the shareholders as dividends are called retained earnings. Retained earnings equals sum of all profits minus sum of all dividends. Retained earnings can be viewed as a pool of money from which future dividends could be paid. In fact, dividends cannot be paid to shareholders unless sufficient retained earnings are on the balance sheet to cover the total amount of the dividend checks. If the company has not made a profit, but rather has sustained losses, it has negative retained earnings that are called its accumulated deficit. Changes in shareholders' equity. Shareholders' equity is just the sum of the investment made in the stock of the company plus any profits, less any losses, minus any dividends that have been paid to shareholders. The value of shareholders' equity increases when the company 1. Makes a profit, thereby increasing retained earnings, or 2. Sells new stock to investors, thereby increasing capital stock. The value of shareholders' equity decreases when the company 1. Has a loss, thereby lowering retained earnings, or 2. Pays dividends to shareholders, thereby lowering retained earnings. Balance sheet summary. The balance sheet presents the financial picture of the enterprise on one day, an instant in time, the date it was written. The balance sheet presents what the enterprise has today, assets, how much the enterprise owes today, liabilities, what the enterprise is worth today, equity. The balance sheet reports has today, assets, equals owes today, liabilities, plus worth today, shareholders' equity. Chapter 3. Income Statement. One of the two main financial statements of a business. The other is the balance sheet. The income statement. The income statement gives one important perspective on the health of a business, its profitability. Note, the income statement does not tell the whole picture about a company's financial health. The balance sheet reports on assets, liabilities, and equity. The cash flow statement reports on cash movements. Also note, the income statement says nothing about when the company receives cash or how much cash it has on hand. The income statement reports on making and selling activities of a business over a period of time. What's sold in the period, minus what it cost, COGS, to make, minus operating expenses for the period, equals income for the period. The income statement documents for a specific period, a month, quarter, or year, the second basic equation of accounting. Sales minus costs and expenses equals income. Net sales. Sales are recorded on the income statement when the company actually ships products to customers. Customers now have an obligation to pay for the product, and the company has the right to collect. When the company ships a product to a customer, it also sends an invoice, a bill. The company's right to collect is called an account receivable and is entered on the company's balance sheet. Note, net sales means the total amount the company will ultimately collect from the sale. That is, list price less any discounts offered to the customer to induce purchase. Sales versus orders. A sale is made when the company actually ships a product to a customer. Orders, however, are something different. Orders become sales only when the products ordered have left the company's loading dock and are en route to the customer. When a sale is made, income is generated on the income statement. Orders only increase the backlog of products to be shipped and do not have an impact on the income statement in any way. Simply receiving an order does not result in income. Costs. Costs are expenditures for raw materials, workers' wages, manufacturing overhead, and so forth. Costs are what you spend when you buy or make products for inventory. When this inventory is sold, that is, shipped to customers, its total cost is taken out of inventory and entered in the income statement as a special type of expense called cost of goods sold. Costs lower cash and increase inventory values on the balance sheet. Only when inventory is sold does its value move from the balance sheet to the income statement as cost of goods sold. Cost of goods sold. When a product is shipped and a sale is booked, the company records the total cost of manufacturing the product as cost of goods sold on the income statement. Remember, when the company made the product, it took all the product's costs and added them to the value of inventory. The costs to manufacture products are accumulated in inventory until the products are sold. Then these costs are expensed through the income statement as cost of goods sold. Gross margin. Gross margin is the amount left over from sales after product manufacturing costs, cost of goods sold, are subtracted. Gross margin is sometimes called gross profit or the company's manufacturing margin. Cost versus expense. Two different terms, cost and expense, are used to describe how the company spends its money. Manufacturing expenditures to build inventories are called costs. All of the other business expenditures are called expenses. Note, using the terms cost and expense correctly will make it easier to understand how the income statement and balance sheet work together. Also note, an expenditure can be either a cost or an expense. The word expenditure simply means the use of cash to pay for an item purchased. Expenses. Expenses pay for developing and selling products and for running the general and administrative aspects of the business. Examples of expenses are paying legal fees and a salesperson's salary, buying chemicals for the R&D laboratory, and so forth. Expenses directly lower income on the income statement. Note, the words profit and income mean the same thing. That is, what's left over from sales after you have subtracted all the costs and expenses. Operating expenses. Operating expenses are those expenditures, that is, cash out, that a company makes to generate income. Common groupings of operating expenses are 1. Sales and marketing expenses, 2. Research and development, R&D expenses, 3. General and administrative, G&A expenses. Operating expenses are sometimes called SG&A expenses, meaning sales, general, and administrative expenses. Income or loss. If sales exceed costs plus expenses, as reported on the income statement, the business has earned income. If costs plus expenses exceed sales, then a loss has occurred. The terms income and profit and earnings all have the same meaning: what's left over when you subtract expenses and costs from sales. Note, the income statement is often referred to as the profit and loss statement, the earnings statement, or simply the P&L. Remember, income is the difference between two very large numbers, sales less costs and expenses. Slightly lower sales and/or slightly higher costs and expenses can eliminate any expected profit and result in a loss. Income from operations. A manufacturing company's operations are all its actions taken in making and selling products, resulting in both expenses and costs. The term income from operations refers to what is left over after expenses and costs are subtracted from sales. Note, companies can also generate income and have expenses from financial, non-operating activities. For example, a manufacturing company makes a non-operating profit when it sells a piece of real estate more than its book value. Non-operating income and expense. Paying interest on a loan is a non-operating expense. Likewise, receiving interest on cash balances in the company's bank account is non-operating income. Because it is from non-operating sources, interest income or expense is reported on the income statement just below the income from operations line. Likewise, income taxes. Note, a company's operations can be producing income, but the company as a whole can still show an overall loss. This sad state of affairs comes about when non-operating expenses, such as very high interest expenses, exceed the total income from operations. Net income. Income is the difference between two large numbers, 1. Sales, and 2. Costs plus expenses. More costs plus expenses than sales, and the company will show a loss. Less costs plus expenses than sales, and the company will show a profit. Remember, income is not cash. In fact, a very profitable company with lots of net income can also be insolvent, that is, with no cash left to pay its bills. Often, rapidly growing companies are short of cash, even though they are highly profitable. They simply cannot supply out of the earnings the capital required for such rapid growth. Income, profits, versus sales, revenue. The words income and revenue are often confused. They mean very different things. Profit and income do mean the same thing. Sales and revenue do mean the same thing. Net income, also called profits, is at the bottom of the income statement. Net sales, also called revenue, is at the top of the income statement. Net income is often referred to as the bottom line because it is the last line of the income statement. Net sales are often referred to as the top line because it is at the top of the income statement. Income statement summary. The income statement summarizes and displays the financial impact of movement of goods to customers, sales, minus efforts to make and sell goods, costs and expenses, equals any value created in the process, income. All business activities that generate income or result in a loss for the company, that is, all transactions that change the value of shareholders' equity on the balance sheet, are recorded here on the income statement. Accrual basis versus cash basis. The two major ways of running a company's books, cash basis or accrual basis, differ on when the company records expenses and income. If income is measured when cash is received and expenses are measured when cash is spent, the business is said to be operating on a cash basis, just like your checkbook. If income and expenses are measured when the transactions occur, regardless of the physical flow of cash, the business is said to be operating on an accrual basis. More later. Cash basis. Cash basis books are the simplest, functioning just like the proverbial cookie jar. When the books are on a cash basis, accounting transactions are triggered only by the movement of cash. With the books on a cash basis, the income statement and the cash flow statement are the same. In general, people run their lives on a cash basis, but most businesses run their books on an accrual basis. Note, all businesses that maintain inventories of product for sale must use accrual accounting to report income, so says the IRS. In businesses with inventory, using accrual accounting helps compute income, profit, properly. Accrual basis. In accrual basis accounting, the income statement does not reflect the movement of cash, but rather the generation of obligations, payables, to pay cash in the future. With accrual basis accounting, expenses occur when the company incurs the obligation to pay, not when it actually parts with the cash. In accrual basis accounting, sales and costs are recorded when the goods are shipped and customers incur the obligation to pay, not when they actually pay. For example, under accrual basis accounting, you would lower your net worth when you use your charge card rather than when you ultimately paid the bill. Income statement and balance sheet. The enterprise's income statement and balance sheet are inexorably linked. If the enterprise's income statement shows income, then retained earnings are increased on the balance sheet. Then also, either the enterprise's assets must increase or its liabilities decrease for the balance sheet to remain in balance. Thus, the income statement shows for a period all the actions taken by the enterprise to either increase assets or decrease liabilities on the balance sheet. Chapter 4. Cash Flow Statement. Where the company gets cash and where that cash goes. Cash Flow Statement. The cash flow statement tracks the movement of cash through the business over a period of time. A company's cash flow statement is just like a check register, recording all the company's transactions that use cash, checks, or supply cash, deposits. The cash flow statement shows cash on hand at the start of the period, plus cash received in the period, minus cash spent in the period, equals cash on hand at the end of the period. Cash transactions. So-called cash transactions affect cash flow. For example, paying salaries lowers cash. Paying for equipment lowers cash. Paying off a loan lowers cash. Receiving money borrowed from a bank raises cash. Receiving money from investors for stock raises cash. Receiving money from customers raises cash. Notice using the words paying and receiving money for those transactions where cash actually changes hands. Non-cash transactions. Non-cash transactions are companies' activities where no cash moves into or out of the company's accounts. Non-cash transactions have no effect on the cash flow statement, but they can affect the income statement and balance sheet. Examples of non-cash transactions include shipping product to a customer, receiving supplies from a vendor, and receiving raw materials required to make the product. For these material transfer transactions, no cash actually changes hands during the transaction proper, only later. Cash comes into the company when the customer pays for the product, not when the company ships it. Cash moves out of the company when it pays for materials, not when the company orders or receives them. Cash flow. A positive cash flow for a period means the company has more cash at the end of the period than at the beginning. A negative cash flow for a period means that the company has less cash at the end of the period than at the beginning. If a company has a continuing negative cash flow, it runs the risk of running out of cash and not being able to pay its bills when due. Just another way of saying broke, tapped out, insolvent. Sources and uses of cash. Cash comes into the business, sources, in two major ways. 1. Operating activities such as receiving payments from customers. 2. Financing activities such as selling stock or borrowing money. Cash goes out of a business, uses, in 4 major ways. 1. Operating activities such as paying suppliers and employees. 2. Financial activities, such as paying interest and principal on debt or paying dividends to shareholders. 3. Making major capital investments in long-lived productive assets like machines. 4. Paying income taxes to the government. Cash from operations. The normal day-to-day business activities, making and selling product of a business, are called its operations. The cash flow statement shows cash from operations separately from other cash flows. Cash receipts are inflows of money coming from operating the business. Cash disbursements are outflows of money used in operating the business. Cash receipts, money in, minus cash disbursements, money out, equals cash from operations. Cash receipts. Cash receipts, also called collections or simply receipts, come from collecting money from customers. Cash receipts increase the amount of cash the company has on hand. Note, receiving cash from customers decreases the amount that is due the company as accounts receivable shown on the balance sheet. Cash receipts are not profits. Profits are something else altogether. Don't confuse the two. Profits are reported on the income statement. Cash disbursements. A cash disbursement is writing a check to pay for the rent, for inventory and supplies, or for a worker's salary. Cash disbursement lowers the amount of cash the company has on hand. Cash disbursements, payments, to suppliers lower the amount the company owes as reported in accounts payable on the balance sheet. Cash disbursements are also called payments or simply disbursements. Other elements of cash flow. Cash from operations reports the flow of money into and out of the business from the making and selling of products. Cash from operations is a good measure of how well the enterprise is doing in its day-to-day business activities, its so-called operations. But remember, cash from operations is just one of the important elements of cash flow. Other major cash flows are 1. Investment in fixed assets, such as buying a manufacturing facility and machinery to make product. 2. Financial activities, such as selling stock to investors, borrowing money from banks, paying dividends, or paying taxes to the government. Fixed asset purchases. Money spent to buy property, plant, and equipment, PP&E, is an investment in the long-term capability of the company to manufacture and sell product. Paying for PP&E is not considered part of operations, and thus is not reported in cash disbursements from operations. Cash payments for PP&E are reported on a separate line on the cash flow statement. PP&E purchases are investments in productive assets. Needless to say, after paying for PP&E, the business has less cash. Cash is used when the PP&E is purchased originally. Note, however, when the enterprise depreciates a fixed asset, it does not use any cash at that time. No check is written to anyone. Net borrowings. Borrowing money increases the amount of cash the company has on hand. Conversely, paying back a loan decreases the company's supply of cash on hand. The difference between any new borrowings in a period and the amount paid back in the period is called net borrowings and is reported for the period on a separate line in the cash flow statement. Income taxes paid. Owing income taxes is different from paying them. The business owes some more income tax every time it sells something for a profit. But just owing taxes does not reduce cash. Only writing a check to the government and thus paying the taxes due actually reduces the company's cash on hand. Paying income taxes to the government decreases the company's supply of cash. Income taxes paid are reported on the cash flow statement. Sale of stock, new equity. When people invest in a company's stock, they exchange one piece of paper for another, real U.S. currency for a fancy stock certificate. When a company sells stock to its investors, it receives money and increases the amount of cash it has on hand. Selling stock is the closest thing to printing money that a company can do, and it's perfectly legal, unless you mislead widows and orphans as to the real value of the stock, in which case the SEC, U.S. Securities and Exchange Commission, will send you to jail. Really. Ending cash balance. The beginning cash balance at the start of the period, plus or minus all cash transactions that took place during the period, equals the ending cash balance. In summary, beginning cash on hand at start of period plus cash received during the period minus cash spent during the period equals ending cash on hand at the end of the period. Cash flow statement summary. Think of the company's cash flow statement as a check register reporting all the company's payments, cash outflows, checks, and deposits, cash inflows, for a period of time. If no actual cash changes hands in a particular transaction, then the cash flow statement is not changed. Note, however, that the balance sheet and the income statement may be changed by a non-cash transaction. Note also that cash transactions, those reported on the cash flow statement, usually do have some effect on the income statement and balance sheet as well. Chapter 5. Connections. These sections will begin our formal study of how the three major financial statements interact, how they work in concert to give a true picture of the enterprise's financial health. In the prior chapters, we studied separately the vocabulary and structure of the three main financial statements. What follows here is an opportunity to put the statements together as a financial reporting tool. We will see how the income statement relates to the balance sheet and vice versa, and how changes to each can affect the cash flow statement. Remember the fundamental reporting function of each of the three main financial statements. 1. The income statement shows the manufacturing and selling actions of the enterprise that results in a profit or loss. 2. The cash flow statement details the movements of cash into and out of the coffers of the enterprise. 3. The balance sheet records what the company owns and what it owes, including the owner's stake. Each statement views the enterprise's financial health from a different and very necessary perspective. Each statement relates to the other two in specific ways. Review these following examples of the natural connections between the three main financial statements. Balance sheet connections. See the basic structural connections between the balance sheet and the other two major financial statements. Sales cycle. Next shown is the sales cycle describing those repeating financial statement entries that the company must make in order to report a sale and receive payment. Expense cycle. Then follow the documenting entries for SG&A and research expenses and their subsequent payment. Investment cycle. Next shown are the connection entries relating to the investment of capital and the acquisition of debt, borrowing. Asset purchase and depreciation. Last shown are entries for asset purchases and depreciation. Here is a hint as you study the reporting of dollars and goods entering or leaving the business and the statements. 1. Watch the flow of cash money. 2. Watch the flow of goods and services. Fundamentally, financial statements document the movement of cash and goods and services into and out of the enterprise. That is all the financial statements are about. It's no more complicated than that. Everything else is details. Don't sweat the details. Balance sheet connections. Structural connections. A. Ending cash balance on the cash flow statement for the period always equals cash at period end on the balance sheet. B. The basic equation of accounting says total assets will always equal total liabilities and shareholders' equity on the balance sheet. Balancing transactions. C. To keep the balance sheet in balance, when a transaction amount is added or subtracted to an asset account, the equal amount must be subtracted or added from another asset account. D. Likewise for liability accounts. In both cases, total assets or total liabilities and shareholders' equity do not change and maintain the balance in the balance sheet. Got that? E. Also, the balance sheet remains in balance if an equal amount is added or subtracted from an asset account and a liability account. Thus, total assets and total liabilities and shareholders' equity increase or decrease by the same amount to maintain the balance in the balance sheet. F. An increase in net income on the income statement is added to retained earnings on the balance sheet. A loss would be subtracted. A change in another balance sheet account will always balance that entry and thus maintain balance sheet balance. See the following cycle descriptions to better understand how this all works. Sales cycle. Recording sales. A. When a sale is made on credit, net sales increases at the top of the income statement and accounts receivable increases on the balance sheet by the same amount. B. When a sale is made and the product purchased is shipped, the product value is moved from inventory on the balance sheet to cost of goods sold, COGS, on the income statement. C. When a sale is entered on the income statement, net income is generated and is added to retained earnings on the balance sheet. Recording payments. D. When the customer pays for the products shipped, the accounts receivable on the balance sheet becomes a cash receipt on the cash flow statement. E. Ending cash balance is increased by the amount added as a cash receipt in C and equals cash on the balance sheet. Balance sheet summary. Total assets on the balance sheet increase by the cash added in E and decrease by the inventory shipped in B. Accounts receivable does not change because the same amount was added in A and then subtracted in C. Total liabilities and shareholders' equity increases by the net income added to retained earnings in D. This amount is the same as the increase in total assets as computed in the prior paragraph. Thus, the balance sheet remains in balance. Hallelujah! Expense cycle. Recording expenses. A. Expenses, when incurred and entered on the income statement, become accounts payable on the balance sheet by the same amount. B. Expenses, when entered on the income statement, also reduce the net income. C. This net income reduction on the income statement reduces retained earnings on the balance sheet by the same amount. Recording expenditures, payments. D. When paid, the accounts payable on the balance sheet becomes an actual cash disbursement on the cash flow statement. Voila! The expense has become an expenditure, actual cash out. E. Ending cash balance is lowered by the amount of the cash disbursement in D and equals cash on the balance sheet. Balance sheet summary. Retained earnings on the liabilities and equity section of the balance sheet is reduced by the amount of the expense. Accounts payable is increased by the same amount, thus keeping the balance sheet in balance so far. When the accounts payable is paid with cash, cash in the assets section of the balance sheet is lowered and accounts payable is lowered too by the same amount. Thus, in summary, total assets and total liabilities and equity are lowered equally and the balance sheet remains in balance. Hallelujah again! Investment cycle. Recording debt. Net borrowings, when entered on the cash flow statement, increase both cash and debt by the same amount. This new debt is entered into either of the two different accounts depending on when it is due for repayment. A. Short-term debt is the portion to be repaid within 12 months. B. Long-term debt is for repayment required in more than 12 months. C. Borrowing increases cash on the balance sheet. Note, A plus B equals C. Selling stock. D. Selling stock increases both cash and capital stock by the same amount on the balance sheet. Balance sheet summary. net borrowings on the cash flow statement increase cash in the assets section and debt in the liabilities and equity section of the balance sheet by the same amount. Sale of capital stock on the cash flow statement increases cash in the assets section and capital stock in the liabilities and equity section of the balance sheet by the same amount. Since these are balancing entries, there is no change in total assets or in total liabilities and equity. The balance sheet remains in balance. Hallelujah again, again. Fixed asset cycle. PP&E purchase. A. When equipment is originally purchased, the account PP&E purchase is increased on the cash flow statement, and fixed assets at cost is increased on the balance sheet by the same amount. B. Ending cash balance is lowered on the cash flow statement, and so is cash on the balance sheet. Depreciation charges. C. Regularly over time, according to a calculated depreciation schedule, a depreciation charge is entered on the income statement as an operating expense and thus lowers net income on the income statement, and D. Since net income has been lowered, retained earnings on the balance sheet goes down by the same amount. E. Also, accumulated depreciation is increased as an expense, thus lowering net income and net fixed assets. Depreciation expenses are so-called non-cash expenses. Note, when a depreciation expense is entered on the income statement, no actual cash disbursement is made and entered on the cash flow statement. Ending cash balance on the cash flow statement and cash on the balance sheet are not lowered. Cash was originally lowered by the full purchase price when the equipment was acquired and paid for. Balance sheet summary. Total assets and total liabilities and equity remain in balance. A and B result in offsetting entries. C, D, and E result in offsetting entries too. Section B. Transactions. Exploits of Appleseed Enterprises, Incorporated. About this section. We are now at the heart of learning how financial statements work. In the previous section, we reviewed financial statement structure and vocabulary and saw examples of how the three main financial statements interact. The following sections chronicle 33 specific business transactions in Appleseed's financial life. We'll show how Appleseed constructs and maintains its books to report accurately the company's financial position. Each new business transaction means new postings to Appleseed's financial statements as our company goes about its business of making and selling delicious applesauce. As we discuss each transaction, you'll get a hands-on feel for how a company's books are constructed. Each transaction is described in a two-page spread. Right-hand page. The right-hand page of each two-page transaction spread describes an Appleseed business transaction discussing both business rationale and financial effect. Note that numbered circles are placed beside descriptions of specific financial postings for the transaction. The large number circles correspond to the entries beside the smaller numbered circles on the left-hand page that shows the company's three main financial statements. As you begin to study each new transaction, first read and understand the right-hand page description, then go to the left-hand page to see actual postings to Appleseed's three financial statements. Left-hand page. The left-hand page of each transaction spread shows required entries into Appleseed's income statement, balance sheet, and cash flow statement. Depending on the type of transaction, all three financial statements may be changed, or just two, or one or none may change. Note, entries are only made in the account lines with boxes at the right. The other lines are just additions or subtractions to show running and grand totals. The account deck shows how the various account lines are summed. That is all there is to accounting and financial reporting. It is really not rocket science at all, just a little addition and subtraction. With some effort, and this book, you will find enlightenment. However, remember, our analysis is just an overview. If you need details, and there are many, just ask an accountant a good question based on the knowledge you have acquired from this book. They will be so happy to get an intelligent question from a non-financial type they will bend over backwards to answer. Welcome to Appleseed Enterprises. Chapter 6. Startup Financing and Staffing. Welcome to our little business, Appleseed Enterprises Incorporated. Imagine that you are Appleseed's entrepreneurial CEO. You also double as treasurer and chief financial officer. You have just incorporated, in Delaware, and invested $50,000 of your own money into the company. Well, actually, it's your great-aunt Lillian's money. You're going to need much more capital to get into production, but these initial transactions will start up the business. Follow along. We have a lot to do. Transaction 1. Sell 150,000 shares of Appleseed's common stock, $1 par value, for $10 per share. Transaction 2. Pay yourself your first month's salary. Book all payroll-associated fringe benefits and taxes. Transaction 3. Borrow $1 million to buy a building. Terms of this 10-year mortgage are 10% per annum. Transaction 4. Pay $1.5 million for a building to be used for office, manufacturing, and warehouse space. Set up a depreciation schedule. Transaction 5. Hire administrative and sales staff. Pay first month's salaries and book fringe benefits and taxes. Transaction 6. Pay employee health, life, and disability insurance premiums, plus FICA, unemployment, and also withholding taxes. T1. Sell 150,000 shares of Appleseed's common stock, $1 par value, for $10 per share. Shares of stock represent ownership in a corporation. A corporation can issue a single class or multiple classes of stock, each with different rights and privileges. Common stock has the lowest preference to receive assets if the corporation is liquidated. Common stockholders vote for the board of directors. Preferred stock has a preference over common stock when the corporation pays a dividend or distributes assets in liquidation. Usually, preferred stockholders do not have the right to vote for directors. Note that claims of both the common and preferred stockholders are junior to claims of bondholders or other creditors of the company. Par value is the dollar amount that is assigned to shares by the company's charter. Par value has little significance other than to keep track of stock splits. There is no connection between the stated par value and any underlying worth of the stock or the enterprise. Transaction. A group of investors is willing to exchange their $1.5 million in cash for stock certificates representing 150,000 common shares of Appleseed Enterprises Incorporated. Note, when the company formed, you bought 50,000 shares of founders' stock at $1 per share for a total investment of $50,000 in cash. Thus, after this sale to the investor group, there will be 200,000 shares outstanding. They will own 75% of Appleseed, and you will own the rest. 1. Take the money, issue the investors' common stock certificates, and run to the bank to deposit the check in Appleseed's checking account. The company has received cash, so on the cash flow statement, record the $1.5 million as sale of capital stock. 2. This $1.5 million in cash is a new asset for the corporation, so increase cash in the balance sheet by the amount received from the investors. 3. Each new asset must create a corresponding liability or offsetting asset, or the balance sheet will be out of balance. Issuing stock creates a liability for the company. In effect, Appleseed owes the new stockholders a portion of its assets. so increase the liability capital stock on the balance sheet by $1.5 million. T2. Pay yourself a month's salary. Book all payroll-associated fringe benefits and taxes. Congratulations! The Board of Directors of Appleseed Enterprises Incorporated has hired you to manage the company at the grand salary of $5,000 per month. Before you spend all of your newfound wealth, let's calculate. 1. Your actual take-home pay. 2. The cut for taxes. And 3. The total expense to the company for fringe benefits and payroll taxes. It costs Appleseed a total of $6,230 to pay your $5,000 in salary, even though you only receive $3,370 in your paycheck. Salary and employment expenses. Monthly salary. Pay to employees, $5,000. Pay to others, $0. Employees FICA. Pay to employees, minus $380. Pay to others, $380. Federal and state withholding. Pay to employees, minus $1,250. Pay to others, $1,250. Employers FICA. Pay to employees, $0. Pay to others, $380. Workmen's compensation. Pay to employees, $0. Pay to others, $100. Unemployment insurance. Pay to employees, $0. Pay to others, $250. Health and life insurance. Pay to employees, $0. Pay to others, $500. Totals per month. Pay to employees, $3,370. Pay to others, $2,860. Total paid to employees and others, $6,230. Transaction. Book all payroll-associated company expenses totaling $6,230, including salary, employer's contribution to FICA, Social Security, and various insurance expenses. Issue yourself a payroll check for $3,370, your $5,000 monthly salary minus $1,250 in federal and state withholding tax, and $380 for your own contribution to FICA. 1A. Salary and fringes are expenses that decrease income. Add the total monthly payroll expense of $6,230 to general and administrative expenses in the income statement. 1B. Also, decrease retained earnings in the balance sheet by the same amount. 2A. So far, your payroll check is the only cash that has left the company. List the $3,370 check under cash disbursements in the cash flow statement. 2B. Also, decrease cash in the balance sheet by the same amount. 3. The remaining $2,860 in expenses due to the government and to various insurance companies is an obligation of the company not yet discharged, that is, owed but not yet paid. Enter this amount under accrued expenses in the liability section of the balance sheet. T3. Borrow $1 million to buy a building. Terms of this 10-year mortgage are 10% interest per annum. Go to the bank and apply for a loan to buy a building to 1. Manufacture and warehouse applesauce, and 2. House the administrative and sales activities of the company. The friendly loan officer agrees that Appleseed has a strong equity capital base and good prospects. She agrees to lend you a cool $1 million to buy the building, but demands that you pledge all the assets of the company to collateralize the loan. That's okay. She also asks for your personal guarantee to repay the loan if the company cannot. What do you say? The correct answer is no. If the business fails, you don't want to lose your home, too. You and your friendly banker agree on a 10-year loan amortization, that is, payback schedule. Transaction. Borrow $1 million to purchase an all-purpose building. This term note will run for 10 years, calling for yearly principal payments of $100,000 plus interest at a rate of 10% per annum. 1A. At the loan closing, the friendly banker deposits $1 million in your checking account, thus increasing net borrowings in the cash flow statement. 1B. Remember also, cash increases by $1 million in the assets section of the balance sheet. 2. The current portion of debt, that is, the amount that will be repaid this year, is $100,000 and is listed in the current liabilities section of the balance sheet. 3. The remaining debt of $900,000 will be repaid more than 1 year in the future and thus is listed as long-term debt in the balance sheet. Note: this transaction just books the loan. We will pay down the principal and interest in a later transaction. T4. Pay $1.5 million for a building to be used for office, manufacturing, and warehouse space. You have found the perfect building for Appleseed Enterprises Incorporated. This 100,000 square foot building is appraised at $1.1 million and the land at $550,000. The building is nicely laid out with 90,000 square feet of manufacturing and warehouse space and 10,000 square feet for offices. You negotiate well and drive a hard bargain. You and the seller agree on a sale price for the building and land of $1.5 million. A good deal for Appleseed. In this transaction, we will buy the building, Appleseed Enterprises' first fixed asset. Fixed assets, also called PP&E for property, plant, and equipment, are long-lived productive assets such as buildings, machinery, and fixtures that are used to make, store, ship, and sell product. Fixed assets are also sometimes called capital equipment. When you acquire a fixed asset, you add its value to the balance sheet as an asset. Accounting convention and IRS regulations do not allow you to immediately expense the cost of acquiring a fixed asset. Because fixed assets have a long, productive life, you can expense only a portion of their purchase price each year as you use them. This yearly expense is called depreciation. We will set up a depreciation schedule later in this book and book a depreciation charge in Transaction 13. Transaction: purchase 100,000 square foot building and land for $1.5 million in cash. This facility will serve as Appleseed Enterprises' headquarters, manufacturing facility, and warehouse. 1. Write a check for $1.5 million to the seller of the building. Record this cash transaction under PP&E purchase in the cash flow statement. 2. Then, lower cash in the balance sheet by the $1.5 million check that you wrote to buy the building. 3. Now you must make another entry to bring the balance sheet back into balance. Increase fixed assets at cost on the balance sheet by the $1.5 million purchase price of the building. Note that this asset is recorded at actual cost, not at an appraised or any other valuation. T5. Hire administrative and sales staff. Pay first month's salaries, book fringe benefits, and taxes. Appleseed will soon be in production, so you had better figure out how to sell applesauce. You will also need help with administrative tasks. Hire some SG&A employees. SG&A stands for Sales, General, and Administrative. SG&A is a catch-all for the expenses not involved in manufacturing, that is, not added to inventory. More on this topic later. Add to Appleseed's SG&A payroll a secretary at the wage of $13 per hour, $2,250 per month, a bookkeeper at a salary of $3,000 per month, salesperson at $4,000 per month, and a sales clerk at $10 per hour, $1,750 per month. Transactions: book this month's payroll-associated expenses of $14,790, $7,680 for sales marketing expense, and $7,110 for general and administrative expense. These expenses include salaries, wages, insurance, and other fringe benefits. Issue payroll checks totaling $7,960 to SG&A employees. 1. 1A. On the income statement, add total monthly payroll expense of $7,680 for the salesperson and clerk to sales and marketing expenses. 1B. Also add the payroll expense of $7,110 for the secretary and the bookkeeper to general and administrative expenses. 2. Decrease retained earnings in the balance sheet by the total SG&A payroll of $14,790. 3A. Issue payroll checks totaling $7,960 and list as a cash disbursement in the cash flow statements. 3B. Decrease cash in the balance sheet by the same amount. 4. The $6,830 due to others is owed but not yet paid. Place this amount as accrued expenses in the liability section of the balance sheet. T6. Pay yourself a month's salary. Book all payroll-associated fringe benefits and taxes. When you put yourself on Appleseed's payroll in Transaction 2 and then hired an SG&A staff in Transaction 5, you issued payroll checks to all new Appleseed employees. However, you did not at that time pay all the payroll-associated expenses for fringe benefits such as health and life insurance or the withholding taxes and the FICA that you deducted from the employees' paychecks. These expenses were booked in the income statement at the time they were incurred, but since they were not at that time actually paid, they became accrued expenses. Such is the accrual basis of accounting. If an expense is booked in the income statement but you have not yet satisfied the obligation by paying it immediately, you must record the expense as accrued on the balance sheet. Transaction. Pay all the payroll-associated expenses that were accrued in Transaction 2 and Transaction 5, including FICA, withholding tax, and unemployment insurance to be paid to the government. Also, pay to private insurance companies the workman's compensation and health and life insurance premiums. 1. Write checks totaling $9,690, $2,860 from Transaction 2, plus $6,830 from Transaction 5 for these accrued expenses. Show payments in cash disbursements in the cash flow statement. 2. Lower cash in the asset section of the balance sheet by the same amount paid above. 3. Lower accrued expenses in the liability section of the balance sheet by the $9,690 paid above. Payment of these expenses have been deferred, accrued. Now that you have paid them, you can, in effect, reverse the original deferring entry. Note: actually paying these accrued expenses does not affect the income statement now. The income statement was already charged when the expenses were incurred as described in Transaction 2 and Transaction 5. Chapter 7. Staffing and Equipping Facility. Planning for Manufacturing. Now begins the fun stuff. In a few short weeks, we will be producing thousands of cases of the best applesauce you have ever tasted. In anticipation of beginning applesauce production, we will design our production techniques, determine raw material requirements, labor needs, figure our costs, and establish methods to keep track of our inventories. Finally, we will order our first raw materials and get everything ready to begin trial production in our new manufacturing plant. Transaction 7. Order $250,000 worth of manufacturing. Pay the remaining $125,000 due. Transaction 8. Hire production workers. Expense first month's salary and wages. Transaction 9. Receive and install applesauce making machinery. Pay the $125,000 balance due. Prepare bill of materials and establish labor requirements. Set up plant and machinery depreciation schedules. Plan monthly production schedule and set standard costs. Transaction 10. Place standing orders for raw materials with suppliers. Receive 1 million jar labels. Appleseed Enterprises Incorporated Summary Financial Statements, Transaction 1 through Transaction 6. At the end of a period, all the financial transaction entries that have taken place in the period are added and then presented as the summary consolidated financial statement for the period. Note: Only the actual account transaction figures are listed in the consolidation. Final sums are computed as always. T7. Order $250,000 worth of manufacturing machinery. Pay half down now. We will need a lot of specialized machinery to make our special applesauce: presses, large stainless steel holding tanks, bottling machines, a labeling machine, and so forth. We contract with ABC Apple Crushing Machinery Incorporated, ABC ACM Inc. for short, to construct and install our equipment at a total cost to Appleseed of $250,000, including delivery charges. Before beginning all its important work, ABC ACM demands a prepayment of $125,000 in cash. The remaining payment of $125,000 will be due upon the completion of installation and qualification of the equipment. Transaction: place an order for $250,000 worth of applesauce making machinery. Make a prepayment of $125,000 with the remaining balance due upon successful installation. 1. Enclose a check for $125,000 with the purchase order to the machinery contractor. Show this prepayment as a property, plant, and equipment purchase on the cash flow statement. 2. Lower cash in the assets section of the balance sheet by the $125,000 contractor prepayment. 3. This prepayment is an asset that Appleseed owns. It can be viewed as a right to receive in the future $250,000 of equipment and only have to issue another $125,000 check to the equipment builder. Since this asset does not fit into any of the other asset categories in our abbreviated sample statements, increase other assets on the balance sheet by the $125,000 machinery prepayment. T8. Receive and install applesauce making machinery. Pay the $125,000 balance due. ABC ACM does a super job, on time and on budget. They submit an invoice for their work and you are happy to pay. The applesauce machinery is installed and ready for operation. These new machines are a productive asset, so called because they will be used to produce our product and make a profit for Appleseed. Note that when you pay for these machines, you just shifted money from one asset category on the balance sheet into another, from cash to fixed assets. The income statement was not affected. When we use and then depreciate these assets, the income statement will take a hit. More later in Transaction 13. Transaction: make final payment of $125,000, the balance due on our new applesauce making machinery. 1. Everything is working well. Accept delivery on the machinery and write a check for the $125,000 balance due. Show this payment as a property, plant, and equipment purchase in the cash flow statement. 2. Lower cash in the assets section of the balance sheet by the $125,000 paid to the contractor. 3. Lower other assets by the $125,000 prepayment that now will be converted to a fixed asset. 4. Increase fixed assets at cost by the total $250,000 cost of the machinery. Half of this amount comes from this transaction, payment of the $125,000 balance due, and half from reversing the other assets account, prepayment of $125,000 that was done in Transaction 7, now that we have received the machinery. T9. Hire production workers. Expense first month's salary and wages. Hire the supervisor at a salary of $3,750 per month and have her start immediately. Using similar calculations to those in the table for Transaction 5, the supervisor will receive $2,720 per month in take-home pay. The company will also pay $2,160 in fringes and various taxes to the government. Salary and fringes for the supervisor total $4,880 per month. We will begin paying the supervisor right away. However, since we have not yet started production, we will charge this month's salary to G&A as a startup expense. Normally, the manufacturing salary and wage expense is charged to inventory. More later. The supervisor starts interviewing hourly production workers. Wages will be $12.50 per hour plus fringes with an expected 40-hour week. Hire 5 workers and tell them to report next month when we expect to start production. Appleseed's manufacturing payroll now totals $17,180 per month, $4,880 for the supervisor, and also $12,300 for the 5 hourly workers. Transaction: book supervisor's salary and associated payroll expenses as a general and administrative expense, since we have not yet started production. Issue first month's salary check. Make no entries for hourly workers since they have not yet reported for work. 1. 1A. On the income statement, add $4,880, the total salary and payroll costs for the supervisor, to general and administrative expense. 1B. Decrease retained earnings in the liabilities section of the balance sheet by the same amount. 2. 2A. Issue a payroll check totaling $2,720 and list under cash disbursements in the cash flow statement. 2B. Decrease cash in the balance sheet by the same amount. 3. The remaining $2,160 in benefits and taxes is owed but not yet paid. Place this amount in accrued expenses on the balance sheet. Manufacturing costing. How much will it cost to make our fine applesauce? How should we account for manufacturing costs? How will we correctly value our inventory? These are essential questions for managing the books and profitability of our business. Manufacturing businesses, such as Appleseed Enterprises, compute product cost by determining and then adding 3 separate cost elements. The 3 common cost elements are A. Raw material costs, B. Direct labor costs, and C. Overhead costs. We will discuss so-called direct costs first, and then overhead costs. Direct costs, basically materials and labor, are simple and easy to understand. After discussing each element of manufacturing cost separately, we will then summarize them into a product standard cost for use in A. Inventory valuation on the balance sheet, and B. Computing the cost of goods sold for entry on the income statement. Overhead costs is a catch-all category for costs that cannot be assigned to a specific product, but rather are ongoing costs required just to keep the plant open. Examples of overhead costs include costs for plant space, heat, light, power, supervisory labor, depreciation, and so forth. Cost of raw materials. See Appleseed's Applesauce Bill of Materials. This table lists all of the materials that go into our product and the unit cost of these materials in normal commercial purchase quantities. Also shown are the amount and cost of materials that go into a single shipping unit of our product, in this instance, a case containing 12 jars of applesauce. From the bill of materials, we see that we buy apples in ton quantities at a price of $120 per ton delivered to our plant. Also, each 12-jar case of our applesauce takes 33 pounds of apples to produce. Because 2,000 pounds of apples costs us $120, we will pay $1.98 for the 33 pounds of apples that will go into a case of applesauce. Using a similar calculation for all the other raw materials in our product yields a total materials cost of $8.55 per 12-jar case. Cost of direct labor. We have designed our plant to manufacture up to 20,000 cases of applesauce each month. Because the plant is highly automated, we will need only 5 hourly workers to achieve this production level. Our total hourly labor payroll for a single month is $12,300 as computed in Transaction 9. Divide this labor cost by the 20,000 cases we plan to produce each month. We compute a direct labor cost of 62 cents for each case of applesauce made. Manufacturing labor cost per case. Hourly payroll per month, $12,000, divided by cases produced, $20,000 equals hourly payroll per case, 62 cents. We have just estimated the first two elements of product cost, materials and direct labor. They were easy compared to what follows: overhead and depreciation. Overhead. It is not difficult to see how material cost should be added as part of product costs. Same for the direct labor. However, overhead is not so simple. It takes more than just materials and labor to make a product. It takes a manufacturing building. It takes machinery. It takes heat, light, and power. And it takes supervisors to make things run smoothly. These costs don't go directly into the product as do materials and labor, but they are costs to make the product nonetheless. We'll next study depreciation charges for Appleseed and then come back to compute total overhead costs and total manufacturing costs for our applesauce. Depreciation. A major cost for Appleseed is the depreciation of machinery and buildings used to make our product. Basically, depreciation is a way of charging to current activities a prorated portion of the original purchase price of long-lived assets. For example, suppose we purchase a $100,000 machine. Over its useful life, it will make 500,000 jars of applesauce. Therefore, each jar should be charged a 20-cent cost for its prorated use of that machine. Thus, we would add 20 cents to the cost of each jar as a depreciation charge. To simplify, both accounting practice and tax laws say that fixed assets, such as buildings and machinery, can be written off or depreciated each year by a certain specified portion of their value. Some assets are written off over a longer useful life, buildings over 20 to 30 years, or a shorter useful life, automobiles over 5 years. Depreciation is just a method of dribbling over time a portion of the purchase price of a fixed asset through the income statement as a period expense, thus lowering profit for that period. When you originally purchased the fixed asset, you pay for the asset all at once with cash, but you only book a calculated portion of the depreciation charge of the cost each month based on the expected useful life of the asset. Depreciation schedule. Look at the Appleseed Enterprises Fixed Asset Depreciation Schedule in the bonus PDF. Listed in the leftmost column are Appleseed's fixed assets. Note that the total amount under original purchase price is the same amount shown on Appleseed's balance sheet for fixed assets at cost. The next column lists the useful life that Appleseed will use to compute depreciation for each asset class. In the next column, we list the actual yearly depreciation amount when using the straight-line method to compute depreciation. Straight-line yearly depreciation equals original cost divided by years of useful life. Note that with straight-line depreciation, the same amount of depreciation is taken for each year. Sometimes used, accelerated depreciation methods can allow you to depreciate more in early years. Book value. The remaining 3 columns show the book value of Appleseed's fixed assets at the end of each of the next 3 years. Book value is just the original purchase price of a fixed asset less all the depreciation charges taken over the years, the so-called accumulated depreciation. The book value of the fixed assets is shown on the balance sheet as net fixed assets. Note that book value is an accounting definition of value. It does not necessarily correspond to any actual resale value or replacement value. Effect on income. Each year, Appleseed will add $85,714 or $7,143 per month to its costs to account for its use of fixed assets throughout the year. This charge will hit the income statement as an element of product cost shown in cost of goods sold, COGS. More later. Effect on cash. Unlike most other expenses, you do not pay a depreciation charge with cash. That is to say, cash balance and cash flow are not affected as you depreciate a fixed asset. Why is this so? Sounds like a free lunch. Depreciation is not free. When you originally purchased the fixed asset, you paid its total cost with cash. The cash flow statement showed the payment at full purchase price. However, this purchase price was not posted on the income statement as an expense at that time. However, we will depreciate the full cost of that long-lived asset, but over time. Depreciation is just a method of dribbling the costs of fixed assets through the income statement over time as you use the assets. Appleseed Enterprises' manufacturing overhead is made up of the supervisor's salary, depreciation charges, and other odds and ends such as heat, light, and power, and general supplies. Most of these costs must be paid regardless of the production volume. That is, these costs are generally the same whether we produce a lot or a little applesauce. Let's compute Appleseed's manufacturing overhead. From Transaction 9, we see that the supervisor's total payroll cost is $4,880 per month. From computations, we see that depreciation is $7,143 per month. Let's assume that all other elements of overhead, heat, power, etc., will cost $8,677 per month. Thus, Appleseed's total manufacturing overhead is $20,700 each and every month as detailed here. Supervisory payroll $4,880, depreciation $7,143, all other costs $8,677. Total monthly overhead $20,700. But note that it all does not go out as cash each month. Remember, depreciation is a non-cash expense, just a bookkeeping entry. The actual cash outlay for overhead is only the supervisor's salary and the all other expense that totals $13,577 each month. Variable costs. Some of Appleseed's manufacturing costs get larger in total with each additional case the company makes. For example, with more cases produced, more raw material is consumed. 10 cases require $85.50 worth of raw materials. 100 cases require $855 worth of raw materials. This type of cost, one that varies directly and proportionally with production volume, is called a variable cost. Direct labor is another example of a variable cost. Fixed costs. A cost that does not normally change with the volume level of production is called a fixed cost. Examples of Appleseed fixed costs are supervisory labor costs and depreciation. Generally, the elements of overhead are fixed costs. What is important about the concept of fixed and variable costs? Costs to produce a manufactured product can vary greatly depending on the 1. Production volume, and 2. Proportion of fixed versus variable cost elements in product cost. Thus, when we talk about the cost of an individual case of applesauce to manufacture, we must also state a production volume. Then the total fixed manufacturing costs can be allocated proportionally to each individual unit of production. Thus, we can establish a cost for inventory valuation and the cost of goods sold. Found in the bonus PDF, the table Product Cost at 3 different production levels shows different product costs at different production volumes. Actual costs to produce a case of applesauce vary between $11.24 and $9.86, depending on whether we produce 10,000 or up to 30,000 cases. The lower case cost is at the higher volume. When we talk about what an individual case of applesauce costs us to make, we must also state a production volume. Now we are ready to compute Appleseed's product costs and determine how to value our inventory. Standard cost system. Okay, let's pull all the manufacturing costs together and compute what a case of applesauce costs to make. But remember, we cannot compute the unit cost of a case of applesauce until we set a monthly level of production. In the production costing chart in the bonus PDF, we have computed the total monthly costs to produce applesauce at 3 different production volumes: 10,000, 20,000, or 30,000 cases per month. We have also computed for these production volumes Appleseed's cost per case. Depending on our monthly production volume, a single case of applesauce can cost between $11.24 at 10,000 cases per month and $9.86 at 30,000 cases per month. Quite a significant difference. This so-called standard cost is an estimate of product unit cost assuming a certain production volume. Accountants use standard cost as a good estimate of the real costs to simplify posting of day-to-day accounting transactions. Establishing a standard cost will be useful for maintaining Appleseed Enterprises books. We will use this standard cost to value inventory and to establish cost of goods sold, COGS, when we sell our product. Appleseed's planned production is 20,000 cases per month. From the table available in the bonus PDF, we expect our actual costs will be $10.20 per case of applesauce we manufacture. The table shows this standard cost broken down by element of cost. We will be using this breakdown in later transactions. Variances. What happens if, at the end of a period, we find that we manufactured either more or less than 20,000 cases per month? Won't the costs then change? Yes, costs will change. We will account for this overestimate or underestimate of costs by making manufacturing variance adjustments to the books. More on how manufacturing variances affect product cost will be discussed in detail later on in the book. T10. Place an order for raw materials, apples, spices, and packaging materials. Receive 1 million specialty printed jar labels at 2 cents each. We must order and receive raw materials before Appleseed can start production. The table in the bonus PDF shows the quantities of the various materials required for our monthly planned production level of 20,000 cases. Place a standing order with your suppliers for delivery of these quantities of raw materials each month. To get a good price and rapid delivery on very special 4-color labels, the printer demands a press run of 1 million labels at 2 cents each. Place the label order and receive the labels from the printer. Transaction. Order and receive 1 million applesauce jar labels at a cost of 2 cents each for a total of $20,000 to be paid 30 days after delivery. 1. Place the labels in raw material inventory for use when we start production. Increase inventories by $20,000 in the Assets section of the balance sheet. 2. We owe our printer for the labels, but we will pay the bill later. Increase accounts payable by $20,000 in the Liabilities section of the balance sheet. Note, simply placing an order for raw materials has no effect on any of the 3 financial statements. However, when you do receive the materials ordered, the balance sheet is modified to account for these new assets, and the balancing new liabilities you owe for the materials is listed as an accounts payable. Chapter 8. Startup of manufacturing operations. We are ready to start producing applesauce. The machinery is up and running, the workers are hired, and we are about to receive a supply of raw materials. While manufacturing goes fairly smoothly, we do botch a half-day's production and have to scrap it. We will learn how to value our inventory at standard and book our first manufacturing variance. Raw materials keep rolling in. Now begins the fun stuff. In a few short weeks, we will be producing thousands of cases of the best applesauce you have ever tasted. Transaction 11. Receive 2 months' supply of raw materials. Transaction 12. Start up production. Pay supervisor and workers for the month. Transaction 13. Book depreciation and other manufacturing overhead costs for the month. Transaction 14. Pay for the labels received in Transaction 10. Transaction 15. Finish manufacturing 19,500 cases of applesauce and move them into finished goods inventory. Transaction 16. Scrap 500 cases worth of work-in-process inventory. Manufacturing variances. What can go wrong and what can go right. Transaction 17. Pay for the 2-month supply of raw materials received in Transaction 11. Transaction 18. Manufacture another month's supply of applesauce. Transaction 11. Receive 2 months' supply of raw materials. Receive 2 months' supply of the rest of the raw materials necessary to manufacture our splendid applesauce. We will buy these materials on credit. Our suppliers will ship the materials to us now and not expect payment for a little while. Now is the time for Appleseed to set up an inventory valuation worksheet. This worksheet will help us compute the value of our inventory as we make and sell applesauce. The worksheet will list the effects of all transactions that change inventory values. The total inventory value at the bottom of the worksheet will always equal the inventory value as shown in the company's balance sheet. Our inventory will be divided into 3 groups, depending on where it is in the manufacturing process. These categories will not show up on the balance sheet. The balance sheet lists only the total inventory figure. But you'll see in future transactions how useful it is to account for inventory valuation using these 3 classifications. Raw material inventory is just what it says: raw, purchased goods unmodified by us and waiting to be processed. Work in process, WIP, refers to materials that are being processed by our machines and by our labor force. Work in process has added value because of our processing. More on this concept later. Finished goods inventory is product finished in our warehouse and ready to ship. For inventory valuation purposes, we will use the standard cost we computed earlier to value our finished goods. Transaction. Receive 2 months' supply of all raw materials: apples, sugar, cinnamon, jars, caps, boxes, worth $332,400 in total. That is $8.55 total materials per case, less 24 cents for the already received labels, times 40,000 cases. 1. Increase inventories account on the balance sheet by the $332,400 cost of these materials. 2. Increase accounts payable on the balance sheet by the value of the materials received. T12. Start production. Pay supervisor and workers for the month. Book payroll-associated fringes and taxes. We are finally ready to produce applesauce. The plant is all set up and the workers have all shown up for work. Yeah! A month's supply of raw material, $8.55 per case times 20,000 cases equals a total of $171,000, is on its way from storage onto the plant floor to await processing. On the inventory worksheet, we will move this raw material into work in process. Also, with this transaction, we will pay our workers and the supervisor a month's salary and wages. Because these salary and wages go toward producing product, they are called costs. These manufacturing costs will be accounted for by adding them to our work-in-process inventory. Thus, our inventory will increase in value by the amount of labor that we add while we process our product. Transaction 9 showed the amounts for our manufacturing payroll. Because we were not yet in production then, we charged the income statement with the expense covering the supervisor's salary. Now that we are manufacturing product, these salary and wages are costs that increase the value of our product and are shown as an increase in the value of inventory. Transaction. Pay production workers' wages and supervisor salary for the month. Book associated fringe benefits and payroll taxes. Cut checks for $9,020 for take-home salary and workers' wages. 1A. Increase cash disbursements by $9,020 in the cash flow statement. 1B. Lower cash by that amount in the balance sheet. 2. Book payroll-associated fringes and taxes of $8,160 as accrued expenses on the balance sheet. 3. Increase inventories on the balance sheet by $17,180. That is $9,020 in salary and wages, plus $8,160 in benefits and taxes. Transaction 13. Book a month's depreciation and other manufacturing overhead costs. As we are busily working on applesauce making, there are a few bean-counting details that must be performed. We are using our new machines in our very beautifully refurbished building. Something has to pay for all this splendor. With this transaction, we will depreciate our machinery and building. This depreciation charge is a manufacturing cost, a legitimate cost of making our applesauce. Thus, when we book this depreciation, we will add it in as a cost of manufacturing by increasing the value of our work-in-process inventory. Remember, all the manufacturing costs go into inventory value. Depreciation is a non-cash transaction, so we will not alter cash or accounts payable when we book Appleseed's depreciation charges. No such luck with the other elements of overhead. We will eventually have to pay for them. Thus, accounts payable will be increased by what we owe. Transaction. Book this month's manufacturing depreciation of $7,143 and $8,677 covering other overhead costs. Note that depreciation is not a cash expense and will not lower our cash balance. But for all the other overhead, we will eventually have to pay with cash. 1. Increase accounts payable on the balance sheet by $8,677 covering the all other manufacturing overhead. 2. Increase accumulated depreciation on the balance sheet by this month's $7,143 depreciation charge. 3. Increase inventories on the balance sheet by $15,820 covering this month's depreciation of $7,143 plus the $8,677 all other manufacturing overhead. T14. Pay for labels received in Transaction 10. We received our applesauce jar labels a month ago, and the printer is very anxious to get paid. When we received the jar labels, we created an accounts payable. When we pay this vendor with cash, we will reverse the payable at the same time we lower cash. Note: paying for this raw material does not affect the values in our inventory valuation worksheet. The inventory was increased by the cost of the labels when we received them and also created an accounts payable. Transaction. Pay for 1 million labels received in Transaction 10. Issue a check to our vendor for $20,000 as payment in full. 1. Cut a check for $20,000 to pay the label printer. Increase cash disbursements by that amount in the cash flow statement. 2. Lower cash by $20,000 in the assets section of the balance sheet since we wrote the check. 3. Lower accounts payable in the liability section of the balance sheet by the $20,000 that we no longer owe since we just paid. T15. Finish manufacturing 19,500 cases of applesauce and move from work in process, WIP, into finished goods inventory. When we have finally boxed our finished jars of applesauce and they are ready for shipping, we place them in our finished goods warehouse. We will value this inventory at standard cost, ready to become a cost of goods sold amount when we ship. On our inventory valuation worksheet, we will decrease work-in-process inventory and also increase finished goods inventory by the same amount, the value of goods we moved from work-in-process to finished goods. Remember, we started out to make 20,000 cases, but somewhere in the process we lost some product and only ended up with 19,500 cases. We will move these 19,500 cases into finished goods inventory. In the next transaction, we will deal with what happened and how to account for the remaining 500 cases. The inventory value of the 19,500 cases to be transferred is $198,900, a $10.20 standard cost times 19,500 cases. Note that while accounting entries are made in our inventory valuation worksheet as we move work-in-process inventory into finished goods, no change is made in the company's income statement, balance sheet, or cash flow statement. Inventory values will become cost of goods sold only when we ship product to customers. Transaction. This movement of inventory into a different class is just an internal management control transaction as far as the financial statements are concerned. There is no effect on the three major financial statements of Appleseed. Inventories on the balance sheet remains the same, regardless of the transfer. However, our inventory valuation worksheet reflects the change in inventory status. T16. Scrap 500 cases worth of work-in-process inventory. After we moved all the product that we could find, 19,500 cases, into finished goods, we looked around for the remaining 500 cases we had expected to make. We started out with enough material to make 20,000 cases, but seemed to have produced only 19,500 cases. The material and labor expenditures for these remaining 500 cases is still recorded in work-in-process inventory. But then, where is the product? Our production supervisor comes up with the answer. It seems that our workers had some trouble starting up some of the new machines. Everything is fixed now, but for the first month of production, every 40th jar of applesauce got smashed in the innards of the conveyor belts. Thus, our output was only 19,500 cases, and we spoiled 500 cases. We still expended the labor to produce 20,000 cases, and we used all the material required to produce 20,000 cases, but at the end we only produced 19,500 cases. Oh well, no use crying over spilled applesauce. But how should we account for the loss? Scrap the value of 500 cases of applesauce, lower the value of work-in-process inventory, and take a corresponding loss on the income statement. Manufacturing variances from standard cost. The most efficient type of cost accounting is one that makes use of predetermined costs, referred to as standard costs. This procedure consists of setting, in advance of production, what the unit cost should be, and upon completion of production, comparing the actual costs with these standard costs. Any differences, either positive or negative, are then applied to the financial statements as a variance in order to reflect product cost reality. Standard costs. We at Appleseed Enterprises use a standard costing system to value our inventory. It is a convenient and accurate way to run the books and to account for what our products cost. But remember, the standard cost is what we expect our product to cost if all goes according to plan. That is, all must go exactly as expected, or excess money spent in one area must be saved in another, if our actual cost is to equal our standard cost. In using a standard costing system, the various costs for materials, labor, and overhead are booked into inventory at their actual amounts. But when product is placed in finished goods and then is sold, the transaction is performed at standard. The difference between the actual and the standard cost is then booked in the accounting records. These differences, if any, are called manufacturing variances. Types of variances. For Appleseed's product and production costs to be at standard, that is, no manufacturing cost variances to have occurred, we must produce 20,000 cases in a month, no more, no less. Otherwise, we will have a volume variance. Our raw material must cost just what we have estimated them to be, no more, no less. Otherwise, we will have a purchase variance. The amount of raw material used must be just as planned. Otherwise, we will have a yield variance. We need no more or less direct labor and no overtime to produce our 20,000 cases. Otherwise, we will have a labor variance. We don't have excess scrap produced in the production process. Otherwise, we will have a scrap variance. For Appleseed's product and production costs to be at standard, that is, for no variances to have occurred, 1. We must produce exactly 20,000 cases a month. 2. Our raw material must cost exactly what we have estimated. 3. The amount of raw material used must be just as planned. 4. We need no more or less direct labor and no overtime to produce our 20,000 cases. 5. We do not have excess scrap produced in the production process. Most often, everything does not come out perfectly. We will then have to apply variances to our books. Remember, our production cost accounting relied upon standard cost. We used this standard cost to apply values to inventory and to cost of goods sold. If actual costs were different, and they always are, hopefully by just a little bit, we will have to adjust the books by entering variance amounts to our inventory value on the balance sheet. Note that while it does not apply to Appleseed production, there is one other kind of possible manufacturing variance, the mix variance. A multi-product company can make more or less of one product than planned. This production difference can result in more or less overhead absorption, depending on the relative overhead contribution of the products actually produced. This under- or over-absorption is accounted for as a product mix variance. In summary, volume variances can occur when we make more or less product than we had planned for. We must then spread our fixed costs and overhead over less product, resulting in a higher cost, or over more product, resulting in a lower cost. Spending variances can occur when raw materials cost more or less than planned. Actual product cost reflects these differences. Labor variances are very easy to understand. If it takes more man-hours to make our product than expected by the standard, then our product must cost more than planned. Transaction. Scrap the value of 500 cases of applesauce from the work-in-process inventory. Take a loss on the income statement for this amount. 1. Reduce inventories on the balance sheet by the $5,100 value of the inventory to be scrapped, that is, 500 cases times the standard cost of $10.20 each. 2. Charge $5,100 to cost of goods sold for the loss in value of the inventory due to scrapping 500 cases of work-in-process inventory. 3. Remember that the resulting loss in the income statement must be reflected as a decrease in retained earnings in the balance sheet. T17. Pay for some of the raw materials received in Transaction 11. With our first month's production successfully placed in our finished goods warehouse, we throw a company picnic and celebration. Halfway through the first hot dog, an important phone call comes in. The president of Acme Apple and Jar Supply Incorporated, our apple and jar supplier, is on the line. He is calling to see how we are doing and when we plan to pay our bill for apples and jars. He suggests $150,000 or so would be appreciated. Because we want to remain on good terms with this important supplier, we tell him the check is in the mail and rush back to our offices to put it there. Looking at our listing of current accounts payable, we note that we owe Acme $79,200 for apples, $184,000 for jars, and $33,200 for jar caps, a total of $296,400 outstanding. Take out the checkbook and write a check for the $150,000 Acme has asked for. Transaction. Pay a major supplier a portion of what is due for apples and jars. Cut a check for $150,000 in partial payment. 1. Cut a check for $150,000 to pay to the supplier. Increase cash disbursements by that amount in the cash flow statement. 2. Lower cash by the $150,000 in the assets section of the balance sheet. 3. Lower accounts payable in the liabilities section of the balance sheet by $150,000 that we no longer owe since we just paid as described. Note: actually paying for raw materials does not affect our inventory value in any way. Inventory value increased when we received the raw material and we created the accounts payable. T18. Manufacture another month's supply of our wonderful applesauce. Things are progressing at our enterprise and the plant is churning out product. With this multiple transaction, we will make another month's worth of applesauce and pay a few bills. Soon we will be ready to ship applesauce to our valued customers. Shown in the Inventory Valuation Worksheet in the bonus PDF are the series K through Q of Inventory Valuation Worksheet entries for the rest of the month. The table in the bonus PDF translates these actions into transactions to post to Appleseed's financial statements. Chapter 9. Marketing and Selling. A wise old consultant once said to me, "Really, the only thing you need to be in business is a customer." Appleseed Enterprises Incorporated is ready to find customers for its super new brand of applesauce. We will begin marketing our product and testing the receptiveness of the marketplace to a new supplier, us. Next, unfortunately, we will suffer one major risk of doing business: the deadbeat customer. Transaction 19. Produce product advertising flyers and T-shirt giveaways. Product pricing, break-even analysis. Transaction 20. A new customer orders 1,000 cases of applesauce. Ship 1,000 cases at $15.90 per case. Transaction 21. Take an order on credit for 15,000 cases at a discounted price of $15.66 per case. Transaction 22. Ship and invoice customer for 15,000 cases of applesauce ordered in Transaction 21. Transaction 23. Receive payment of $234,900 for shipment made in Transaction 22. Pay the broker's commission. Transaction 24. Oops! The customer from Transaction 20 goes bankrupt. Write off cost of 1,000 cases as a bad debt. T19. Produce product advertising flyers and T-shirt giveaways. The usual method of selling our type of product is through a food broker to a retail store and then, ultimately, to the consumer. Food brokers serve the purpose of manufacturers' representatives, convincing retailers to stock various brands of product. For their efforts, these brokers receive a commission of about 2% of all sales. They do not take title to the goods, they just smooth the way. Appleseed engages a top-flight manufacturer's representative, Slick Sales and Associates, to market its products. Slick Sales and Appleseed negotiate a sales commission of 2% of gross revenue to be paid to Slick Sales for placing Appleseed's applesauce with retailers. Slick Sales requests that Appleseed prepare and then supply them with sales literature to be given to prospective customers. Everybody agrees that a direct mail promotion would be a good idea too. We hire an advertising agency to design, print, and mail a very fancy brochure to promote Appleseed's applesauce products. The agency also produces 10,000 Appleseed applesauce T-shirts to ship to supermarkets for use as a promotional giveaway. Transaction. Our advertising agency submits a bill for designing, printing, and mailing 4,500 very fancy brochures at $38,250 total cost. The 10,000 t-shirts cost $6.50 each for a total of $65,000. Book these amounts as an Appleseed Enterprises marketing and selling expense. 1. Book brochure and t-shirt expenses totaling $103,250 under sales and marketing expense in the income statement. 2. Lower retained earnings in the liabilities section of the balance sheet by this $103,250 selling and marketing expense. 3. Increase accounts payable in the liabilities section of the balance sheet by the same amount for the bill we owe the advertising agency. Product costing, break-even, and pricing for profit. Profit is the difference between two large numbers, A. Sales, less B. Costs and expenses. Small changes in either can result in large swings in profit, loss. Volume, cost, and price are all connected to ultimate enterprise profitability. How? Marketing textbooks say that pricing decisions are best made in the marketplace. Price setting should be based on a competitive understanding and on our competitive goals. Manufacturing costs should have little bearing on pricing decisions. After we have set a competitive price, we should then look at our costs to see if an adequate profit can be made. If we can't make our desired profit selling our applesauce at a competitive price, then we have just two options: lower costs or exit the business. Market pricing. Who are Appleseed's applesauce competitors? How does our product compare with their offerings? What do they charge for their applesauce? What should we charge to be competitive and profitable? The chart in the bonus PDF shows the wholesale and retail pricing structure for several brands of applesauce sold in our market. The chart translates the various markups, manufacturers, wholesalers, and retailers' markups, into selling and cost prices at each level of distribution. Remember that a lower-level distributor's price is the next upper-level distributor's cost. We decide to position Appleseed's applesauce as a mid-priced brand of a very high quality. We think that at a retail price of $1.90 a jar, or $22.86 for a case of 12 jars, we offer good value. But can we make a profit at this selling price? A break-even analysis will help us answer this important question. Review the volume and costs analysis available in the bonus PDF. Then, look at the break-even chart available in the bonus PDF. Break-even analysis. Financial types, such as Appleseed's bankers, will ask the question, how much will you have to sell to make a profit? This revenue value, where increasing volume turns losses into profits, is called the company's break-even point. The break-even point is that sales volume where revenues are exactly equal to costs plus expenses, and thus the company neither makes a profit nor suffers a loss. Your banker is sizing up the company's product and marketing efforts and gauging whether we can achieve a profitable sales volume. A break-even analysis focuses management on the inherent profitability or lack thereof of an enterprise. Let's do a break-even analysis for Appleseed. The table in the bonus PDF shows Appleseed's annual costs and expenses at various sales and production volumes. Some of Appleseed's costs and expenses will not change with its volume of production and sales, fixed costs, and some will change, variable costs. Fixed costs. Fixed costs will be the same for Appleseed month after month, whether the company makes 5,000 cases, 10,000 cases, or even 20,000 cases per month. This fixed cost includes manufacturing costs and also SG&A expenses that are not related to volume. As shown in the table, we can see that Appleseed's fixed costs are $822,898 per year. Variable costs. Each time Appleseed sells a case of applesauce, it spends $9.483 in variable cost, as shown in the table in the bonus PDF. So, if the company sells 10,000 cases per month, that is 120,000 cases per year, total variable cost will be $9.483 per case times 120,000 cases, for a total of $1,137,960 variable cost. If Appleseed sells 20,000 cases per month, then the total variable cost will be doubled to $2,275,920. Appleseed's break-even chart graphically represents the relationships shown in the table between A. Total revenue, B. Fixed costs, C. Total variable costs, and D. Profit or loss from production volumes from 0 to 25,000 cases shipped per month. Appleseed turns a profit at a production and sales volume of about 10,700 cases per month. Profitability improves nicely as sales and production reach our 15,000 case per month target. Note that the difference between total variable cost and total sales is often called contribution, the dollar amount that a level of sales contributes toward paying for fixed costs and expenses and any profit for the enterprise. The break-even point occurs when the contribution exactly equals all variable costs. Price-volume curve. However, Appleseed certainly wants to be a profitable enterprise, not just a break-even one. To set an optimal price for our applesauce, we need to construct a price-volume curve for our expected sales against our competitors in the marketplace. If we raise prices, unit sales may fall. If we lower prices, absolute profits may fall if the lower price does not result in enough of a volume increase to compensate. The price-volume curve describes this relationship graphically. To construct the graph, we ask, what would be the estimated sales volume if the product price was increased by 10% or by 20%? We make similar volume estimates if the price was lowered. Along with the current selling price and volume estimates, we now have 5 data points on the curve. See the sample graph in the bonus PDF plotting cases sold versus wholesale selling price for our applesauce. Most often, these graphs are fairly linear with a downward slope. The higher the price, the lower the volume sold. If the line drops fast, small change in price causes a large drop in volume, the demand is said to be elastic. A shallow sloped line, large change in price causes a small drop in volume, describes an inelastic demand curve. Our curve has normal elasticity for our type of product. Profit maximization. Now the fun part begins. How should we price our applesauce to generate maximum sales? How should we price our product for maximum profitability? The two prices are often slightly different due to the ratio of fixed versus variable costs. See the sample graphs in the bonus PDF plotting total revenue and total profit versus the wholesale selling price. Total revenue peaks at a selling price of around $15 and maximum total profit at about $16.10 per case. We split the difference and set our list price at $15.90, but will discount it to $15.66 for large orders. See Transaction 20 and Transaction 21. We'll see what happens. T20. A new customer orders 1,000 cases of applesauce. Ship 1,000 cases at $15.90 per case. It's the moment we have all been waiting for. Appleseed Enterprises' very first customer. Your brother-in-law is the manager of a small convenience store chain. At the instigation of your spouse, he places an order for 1,000 cases to stock applesauce in his Northwest region's stores. Based on past experience, you trust your brother-in-law about as far as you can throw him, and he weighs in at 240 pounds. You accept the order but ask him to send a $15,900 prepayment check before you will ship. He says no. You decide to ship on credit and cross your fingers. Transaction. Receive order for 1,000 cases of applesauce at a selling price of $15.90 per case. Ship product and send a $15,900 invoice to the customer. 1. 1A. Book your first sale of $15,900 as net sales on Appleseed's income statement. 1B. Add an accounts receivable for the same amount in the balance sheet. 2. 2A. Book on the income statement the 2% commission, $318 for our broker as a sales and marketing expense. 2B. Also book this $318 commission in accrued expense on the balance sheet. The broker does not get paid until we do. 3. 3A. Reduce inventories on the balance sheet by $10,200. 1,000 cases times standard cost of $10.20 for each case. 3B. Corresponding to the inventory reduction above, increase cost of goods sold by $10,200, the standard cost of 1,000 cases of applesauce. 4. Increase retained earnings on the balance sheet by $5,382, the sale amount less cost of goods less the selling commission. That amount is Appleseed's profit on the sale. T21. Take an order on credit for 15,000 cases of applesauce at $15.66 per case. Our broker is beginning to do his job. We may soon receive a big order from one of the largest food retailers in the area. We have the goods in inventory, so we promise to ship promptly. To close the deal, we authorize our broker to offer the prospective customer a 1.5% discount. The retailer agrees to purchase 15,000 cases at a discounted selling price of $15.66 per case, $15.90 list less the 24-cent discount. Transaction. Receive an order for 15,000 cases of applesauce at a selling price of $15.66 per case, $234,900 for the total order. Note: receiving an order has no effect on the three major financial statements. Only when the product ordered is shipped to customers do you record a sale and the associated cost of goods. T22. Ship and invoice customer for 15,000 cases of applesauce ordered in Transaction 21. Although we did lower our price to get this large order, our costs will remain the same. Thus, we will garner a lower profit in this transaction than if we had sold at full list price. Appleseed's net sales amount will be $234,900 versus the $238,500 if we had sold at list price, a difference of $3,600 in lower sales. Our gross margin, that is, sales less cost of goods sold, will be $81,900 versus $85,500. Again, a difference of $3,600 less margin. In fact, this $3,600 difference in the original selling price will drop all the way to the bottom line as a lower profit. Discounts are dangerous profit gobblers. Try to use them sparingly. Transaction. Ship 15,000 cases of applesauce and send a $234,900 invoice to the customer. 1. 1A. Book sale of $234,900 as net sales on Appleseed's income statement. 1B. Make a corresponding entry as an accounts receivable on the balance sheet. 2. 2A. On the income statement, book cost of goods sold for this sale of $153,000 equaling a $10.20 standard cost per case times 15,000 cases shipped. 2B. Reduce inventories on the balance sheet by this same amount. 3. 3A. Book on the income statement a sales and marketing expense of $4,698 as the 2% selling commission for our broker. 3B. Also book this expense in accrued expenses on the balance sheet. 4. Increase retained earnings on the balance sheet by $77,202. The sale amount less cost of goods sold less the selling commission. T23. Receive payment of $234,900 for shipment made in transaction 22 and pay the broker's commission. Our big customer is very happy with our applesauce. He says that our brightly colored jars are walking off the shelves. We're extremely happy that we decided to spend so much money on very fancy packaging. Although it is true that all you really need to be in business is a customer, what you really need is a customer who pays. With this transaction, we will collect our first accounts receivable and turn it into cash. Transaction. Receive payment of $234,900 for shipment that was made in transaction 22. Pay the broker his $4,698 selling commission. 1A. Book $234,900 in cash receipts in the cash flow statement. 1B. Decrease accounts receivable on the balance sheet by the same amount. 2A. Issue a $4,698 check to our broker and record in cash disbursements in the cash flow statement. 2B. Lower accrued expenses by the amount paid the broker. 3. Increase cash by $230,202 on the balance sheet. That is, $234,900 received less $4,698 disbursed. Note: a customer's cash payment for goods in no way changes the income statement. The income statement recorded a sale when A. we shipped the goods and B. the customer incurred the obligation to pay, our accounts receivable. T24. Oops! Customer goes bankrupt. Write off as a bad debt the cost of 1,000 cases and reverse the sale. Sigh. Remember back in transaction 20 we shipped 1,000 cases of applesauce to your brother-in-law's company? You'll never guess what happened. They went bankrupt. Now he even wants a job. We will never get paid, and because the goods have already been distributed and sold to applesauce lovers around the Northwest, we will never get our product back either. Transaction. Write off the $15,900 accounts receivable that was entered when you made the 1,000-case shipment. Also, reduce the amount payable to our broker by what would have been his commission on the sale. If we don't get paid, he doesn't either. 1A. Book the bad debt expense of $15,900 against general and administrative expense on the income statement. 1B. Reduce accounts receivable on the balance sheet by the $15,900 we will never collect. These entries reverse the sale we had made. 2A. Book a negative expense of minus $318 in sales and marketing expense on the income statement. 2B. Decrease accrued expense on the balance sheet by the same amount. These entries reverse the commission that had been due our broker. 3. Reduce retained earnings on the balance sheet by $15,582. The sale amount we wrote off less the commission no longer due. Note: our out-of-pocket loss is really just $10,200 in the inventory value of the goods shipped. Remember, in transaction 20, we booked a profit from this sale of $5,382. The $15,900 sale minus the $10,200 cost of goods sold minus the $318 selling commission. Thus, if you combine the $15,582 drop in retained earnings booked in this transaction plus the $5,382 increase in retained earnings from transaction 20, you are left with our loss of $10,200 from this bad debt. Chapter 10. Administrative Tasks. We've been busy making and selling our delicious applesauce. However, having been in business for 3 months, it's time to attend to some important administrative tasks. Transaction 25. Pay this year's general liability insurance. Transaction 26. Make principal and interest payments on 3 months' worth of building mortgage borrowing. Transaction 27. Pay payroll-associated taxes and insurance benefit premiums. Transaction 28. Pay some suppliers, especially the mean and hungry ones. T25. Pay this year's general liability insurance. During the first month we were in business, many insurance brokers dropped by to try to sell us their wares. We selected Lightning Bolt Brokers as our insurance agent. Lightning Bolt put together a package of building insurance, liability insurance, and business interruption insurance that appeared to meet our needs. We signed up for coverage, and the broker said that she would send us a bill for the year, which we just got yesterday. Transaction. With this transaction, we will pay a full year's insurance premium of $26,000, giving us 3 months prior coverage, the amount of time we have been in business, and also coverage for the remaining 9 months of our fiscal year. 1. 1A. Issue a check for $26,000 to the insurance broker and book in cash disbursements in the cash flow statement. 1B. Lower cash on the balance sheet by the amount of the check. 2. Book as a general and administrative expense on the income statement the $6,500 portion of the premium covering the last 3 months. 3. Book in prepaid expenses on the balance sheet the remaining $19,500 premium covering the next 9 months. Note, as time goes by, we will take this remaining $19,500 as an expense through the income statement. The transaction at that time will be to book the expense in the income statement and at the same time lower prepaid expenses in the balance sheet. 4. Reduce retained earnings in the balance sheet by the $6,500 loss due to the expense we have run through the income statement. T26. Make principal and interest payments on 3 months' worth of building debts. Review the loan amortization schedule in Transaction 3. It shows how we must pay back the money we owe on the purchase of our building. Also, the fine print in the loan documentation says we must pay the principal and interest quarterly. 3 months have gone by since we got the loan, so interest and principal payments are now due. According to the amortization schedule, this year we owe a total of $100,000 in principal payments and also $100,000 in interest payments. Transaction. Make a quarterly payment of $25,000 in principal and also a $25,000 interest payment on the building mortgage. 1A. Lower retained earnings in the cash flow statement by the $25,000 principal payment. 1B. Book in cash disbursements for the $25,000 interest payment. 1C. Lower cash on the balance sheet by the total $50,000 in cash that left the company. 2. Lower long-term debt on the balance sheet by the $25,000 principal payment made above. 3A. Book the interest payment as a negative $25,000 under net interest income on the income statement. 3B. Then book the resulting loss in retained earnings on the balance sheet. Note, the interest payment entry on the income statement for this transaction is booked as a negative number since the account used to record the payment is interest income. If we had a category interest expense on the income statement, then interest payments would be booked as a positive number. Either way, retained earnings decreases by $25,000. Got that? It's important to pay attention to the exact account meaning when determining whether an entry should be positive or negative. T27. Pay payroll-associated taxes and insurance benefit premiums. We have some payroll-associated taxes and insurance benefit payments that are due for payment. We had better pay them. The government gets very nasty if we don't pay all withholding and FICA premiums when they are due. These obligations are some of the few debts that cannot be erased by bankruptcy. Also, if the company does not pay these debts, the IRS often goes after officers of the company personally to collect the government's due. Transaction: pay payroll taxes, fringe benefits, and insurance premiums. Write checks to the government and to insurance companies totaling $18,480 for payment of withholding and FICA taxes and for payroll-associated fringe benefits. 1A. Book a cash disbursement of $18,480 in the cash flow statement. 1B. Lower cash on the balance sheet by the same amount. 2. Lower accrued expenses on the balance sheet by the $18,480 amount paid to the government and to various insurance companies. Note: the income statement and retained earnings are not affected by this payment transaction. Because Appleseed runs its books on an accrual basis, we already expensed these expenses when they occurred, not when the actual payment is made. T28. Pay some suppliers, especially the mean and hungry ones. Several of our raw material suppliers have telephoned recently and asked how we are doing. And, by the way, when are we planning to pay their bills? Because we are in a check-writing mood and because we will shortly be asking them to send us more apples, we pay a chunk of those supplier bills. Transaction: pay suppliers a portion of what is due for apples and jars. Cut a check for $150,000 in partial payment. 1. Write a check for $150,000 to pay suppliers. Increase cash disbursements by that amount in the cash flow statement. 2. Lower cash by $150,000 in the assets section of the balance sheet. 3. Lower accounts payable in the liability section of the balance sheet by the $150,000 that we no longer owe since we just paid as described. Chapter 11. Growth, Profit, and Return. With these transactions, we will fast forward through the rest of Appleseed's first year in business. We will determine our profit for the year, compute the income taxes we owe, declare a dividend, and issue our first annual report to shareholders. Taxes and dividends. One bad, one good? Actually, without taxes, there would be no dividends. Dividends are paid out of retained earnings. If the business has earnings, and thus can pay dividends, then it will have to pay taxes. Taxes with earnings, no taxes with no earnings. No earnings, then no dividends. Thus, no taxes, no dividends. But enough of this. Some really exciting events are taking place at our now not-so-little company. We have attracted the attention of a large nationwide food processing conglomerate. The president of the conglomerate particularly likes our applesauce. She may make us an offer to buy the company. How much is it worth? Transaction 29. Fast forward through the rest of the year. Record summary transactions. Transaction 30. Book income taxes payable. Transaction 31. Declare a $0.375 per share dividend and pay to common shareholders. Cash flow statement format versus changes in financial position format. Appleseed Enterprises Incorporated annual report to shareholders. What is Appleseed worth? How to value a company. T29. Fast forward through the rest of the year. Record summary transactions for the remainder of the year. Appleseed Enterprises Incorporated has been in business for about 3 months now. We seem to have gotten the hang of recording transactions and manipulating the income statement, cash flow statement, and balance sheet. It is fun! With this series of entries, we will compress and summarize all the remaining transactions that took place in Appleseed's next 9 months of operations. As you can see from the statements, we sold about $2.8 million in applesauce during the last 9 months of the year, and a total of $3.1 million for the whole year. We also collected a little less than $2.6 million from customers during the year and paid out a little over $2.7 million to suppliers, employees, etc. Significantly, we have turned cash flow positive. That is, more cash receipts than cash disbursements, to the tune of $64,520 during the last 9 months of our fiscal year. Note that we were still cash flow negative by $136,538 for the whole year. The bookings in this summary transaction close out our first year in business. Let's review the bottom line. Income from operations amounted to $491,687. Subtract from this figure the interest paid on the building debt, and we have a total of $391,687 as our pre-tax profit for the year. A very nice showing. Taxes next. Transaction. Book a series of entries in the income statement, cash flow statement, and the balance sheet summarizing transactions that take place in the remaining 9 months of Appleseed Enterprises' first fiscal year. T30. Book income taxes payable. Taxes are very simple. For almost all corporations, you just take the pre-tax income and multiply it by the current federal corporate tax percentage, currently 21% in the U.S. State corporate income tax rates vary. We will use 8% here. Then you take out your checkbook and write a check to the government for that amount. If you fail to send in the money on time, or if you fudge the books and the IRS catches you, then you go to jail. See? I told you taxes were simple. With this transaction, we will compute and then book the income taxes we owe the government. We will actually pay them later on the tax due date. Transaction. On a pre-tax income of $391,687, Appleseed owes 21% in federal income taxes, $82,254, and 8% in state income taxes, $31,335. A total income tax bill of $113,587. We will not actually pay the tax for several months. 1A. Book an income tax expense of $113,587 in the income statement. 1B. Lower retained earnings by the same amount in the balance sheet. 2. Book $113,587 worth of income taxes payable in the liabilities section of the balance sheet. T31. Declare a $0.375 per share dividend and pay to the common shareholders. This transaction will be our last for Appleseed Enterprises this year, just before we close the books. The company has done well in its first year of operation, and the board of directors decides to vote a dividend for common shareholders. The question is, how big a dividend? Dividends are paid out of retained earnings, of which we have more than $250,000 as of the end of the year. We also have a very strong cash position, so we can afford to pay the dividend. After much discussion, a $0.375 per share dividend is voted. With 200,000 shares outstanding, this dividend will cost the company $75,000, $56,250 to the investor group, and $18,750 for you, the entrepreneur. You go out and buy a small boat. What you really want is a 42-foot Hinckley. Transaction. Declare and pay $0.375 per share dividend to Appleseed's shareholders. 1A. Book a cash disbursement on the cash flow statement for the $75,000 dividend payment. 1B. Reduce cash on the balance sheet by the same amount. 2. Reduce retained earnings on the balance sheet by the dividend payment of $75,000. Note, the cash flow statements on these transaction spreads are abbreviated. That is, they do not have all the line items that a complete statement would have. The dividend payment should really be placed on a special line titled Dividends Paid rather than in cash disbursements. Paying a dividend is not an operating expense, and the cash disbursements line should be used for operating expenses only. Appleseed Enterprises Annual Report. To our shareholders, I am happy to have this opportunity to report to you the results of Appleseed Enterprises Incorporated's first year of operation. Your company, in a very short time, has achieved its initial goal of becoming a recognized supplier of very high-quality applesauce. Important events. At the beginning of the year, Appleseed raised $1 million through a successful offering of its common stock. This capitalization has allowed us to purchase high-volume production machinery and to maintain sufficient inventory to break into the highly competitive applesauce industry. Our production continues at over 20,000 cases per month. As demand increases, we project that the current manufacturing facility can be operated at over twice these levels. Depending, however, on the weather conditions in the Northeast, raw material supply may limit our ability to reach increased levels of production. Financial results. In Appleseed's first year of operation, our revenues exceeded $3 million. Appleseed's net income for the year was over $278,000, or $1.39 per share on 200,000 shares outstanding. Our return on sales of 9.1% exceeds industry averages, as does our 15.9% return on shareholders' equity. Return on assets was 8%. Our balance sheet remains strong. We end this year with over $488,000 in cash and cash equivalents. Appleseed continues to spend heavily in marketing and sales. We believe these investments will pay off handsomely in the future in significantly improved market position, especially in specialty segments of the applesauce industry. During the coming year, we plan to introduce several new jar sizes and packaging configurations into the gift market. Product testing continues on specialty flavored and colored versions of our basic applesauce. A bright green sauce packaged in a shamrock-shaped jar will be introduced prior to St. Patrick's Day this year. We expect our new products to be well received in the marketplace. I thank our customers for their continuing confidence in our products and in our ability to serve their applesauce needs. I thank our shareholders for their continuing support and our employees for their productive efforts throughout Appleseed's first year of operation. Sincerely, I am Rich, President and CEO. What's a business worth? We've done a splendid job starting up an applesauce company. What do you think the business is worth now? A good question, one of interest to Appleseed's shareholders. Let's look at several methods of company valuation. Book value. Book value represents the value at which assets are carried on the books of the company. The book value of a company is defined as its total assets less its current liabilities and less any long-term debt. For Appleseed Enterprises Incorporated, book value is computed as $1,753,100. That is, $3,029,419 in total assets, less a total of $476,319 in current liabilities, less some $800,000 in long-term debt outstanding. Liquidation value. The liquidation value is what the company's assets would bring at a forced sale. Normally, the liquidation value of a going concern has little relevance since the value of an operating business is much greater than its liquidation value. For fun, let's compute Appleseed's liquidation value. Start with the company's book value, then subtract what would lower that amount if, for example, we could only get 10 cents on the dollar for inventory and 50 cents on the dollar from machinery. Using these assumptions, Appleseed's liquidation value would be about $500,000. The bank would take it all. Price-earnings multiple. The company has 200,000 shares outstanding and earned a net income of $278,100 last year. Dividing net income by the number of outstanding shares gives us a net income of $1.39 per share. If we assume that companies like Appleseed are currently selling at, say, 12 times earnings, then our company is worth $1.39 times this 12 multiple times 200,000 shares outstanding, equaling a value of over $3.3 million. Wow! Market value. There is no market for Appleseed stock. The company is closely held. Thus, there is no real market value for the company. Selling a private company is like selling a house. The business is worth what you can get for it. Discounted cash flow. The discounted cash flow method of valuation is the most sophisticated and the most difficult method to use in valuing the business. With this method, you must estimate all the cash influxes to investors over time, dividends, and ultimate stock sales, and then compute a net present value using an assumed discount rate, implied interest rate. There are just too many assumptions in this method to make it very useful in valuing Appleseed. However, review the discussion in Chapter 21, Net Present Value, for a more detailed view on these calculations. Section C. Financial Statement Construction and Analysis. About this section. Congratulations! You have accurately kept the books of Appleseed Enterprises, Incorporated, for the year. And a good year it was. What follows in this section are some techniques and details. Journals and ledgers. We'll learn about the books that accountants use to make transaction entries. Accountants did once use paper entry books and did sit atop high chairs. Now entries are made in computer memory. Some say that computers have made it easier to commit fraud. When ledgers were paper books and entries were made with India ink, things were more difficult to fudge. Ratio analysis. Next, we will review the common ways of analyzing financial statements to test the financial strength of the enterprise. We will review the liquidity of the company, how efficiently it uses its assets, how profitable it is, and how effectively it is using other people's money, that is, debt. Accounting policies. We will review the different but acceptable ways to keep the company's books and why companies would want to use them. Note that some of these creative accounting techniques can be used to mask problems in the enterprise. Cooking the books. Finally, we will discuss the ways of financial fraud and how to detect it. Some tried-and-true fraudulent techniques are important to understand whether you are an employee or an investor in the company. Chapter 12. Keeping track with journals and ledgers. Financial accounting means recording each and every event, a transaction, that has a financial impact on the enterprise. By keeping track of these activities just as they happen, the accountant can easily summarize the firm's financial position and issue financial statements. Journals and ledgers are the books in which accountants scribble transaction entries. The general journal is a book or a computer memory in which all of a company's financial events are recorded in chronological order. Everything is there. There is nothing missing. Journal entries can and must be made if 1. We know with reasonable certainty the amount of money involved. 2. We know the timing of the event. 3. An actual exchange between the parties of cash, goods, or some formal representation of value, such as stock, has occurred. A ledger is a book or computer memory of accounts. An account is simply any group of similar items of which we want to keep track. You can think of a ledger as a book with many pages. Each page of the ledger book represents one account. The main benefit of a ledger system is that it allows us to determine how much we have of any item, account, at any point in time. Immediately after making a chronological journal entry, we update our ledger for each account that has changed as a result of that entry. Note that every time we make a journal entry, we will be changing amounts in at least 2 accounts, ledger pages, in order to keep the balance sheet and the basic equation of accounting in balance. Assets must always equal liabilities plus equity. Any event having a financial impact on the firm affects this basic equation in some way or another. Financial statements. This basic equation summarizes the entire financial position of the firm. Furthermore, the equation must always stay in balance. To keep this equation in balance, a change in any one number in the equation must change at least one other number. Accountants call this system of making ledger changes in pairs the double-entry bookkeeping system. In the bonus PDF are several of the account ledgers for Appleseed Enterprises. Each ledger shows how our transactions have affected a single account. Note that at all times, the ledgers present a current picture of Appleseed's account balances. The cash ledger lists all transactions that affect the amount of cash in Appleseed Enterprises checking accounts. The ending cash balance on the cash ledger is the same amount as shown for the cash account on the balance sheet for the date of the last transaction. Shown in the bonus PDF are additional Appleseed Enterprises Incorporated ledgers. Note that for each of Appleseed's ledgers, the rightmost column shows the account value as of the completion of the transaction listed. Ledgers should always be kept current. Then, when statements need to be prepared, the ledgers will always provide correct account balances. The General Journal is a book or computer memory in which all of a company's financial events are recorded in chronological order. Everything is there, nothing is missing. A ledger is a book or computer memory of accounts. An account is any grouping of items of which we want to keep track. You can think of a ledger as a book with many pages. Each separate page in the ledger book represents one account. Chapter 13. Ratio Analysis. It is not so much the absolute numbers of sales, costs, expenses, and assets that are important in judging the financial condition of an enterprise, but rather the relationships between them. For example, high cash available relative to the level of payables is a good indicator of how easily the company will be able to pay its bills in the future. Asset levels relative to sales volume indicates just how efficiently the company's investments in productive assets, machinery, and inventory can generate revenue. Gross margin, as a percentage of sales, determines how much the company is able to spend on various selling, development, and administrative activities and still make a profit. Ratio analysis, that is, comparing one number on a company's financial statement with another number, is most useful when you wish to 1. Compare year-to-year performance to determine if things are getting better or getting worse for the enterprise, or 2. Compare companies in an industry to see which is performing best given common constraints. In this section, we will review Appleseed Enterprises' first-year financial performance by analyzing the company's financial statements and the common ratio indicators of liquidity, asset management, profitability, leverage. Finally, we will compare ratios across industries. Some businesses are naturally more profitable than others. Some require more capital, some require less. The ratios computed in the following sections use Appleseed Enterprises Incorporated's income statement and balance sheet for the period from Transaction 1 through Transaction 31 shown in Appleseed's annual report in the bonus PDF. Common size statements. Both the income statement and the balance sheet can be converted into common size statements for analysis. Common size statements present each item as a percentage of the statement's largest item. Common size income statement. Normally, the largest item in the income statement is sales. Thus, when the income statement is converted into a common size statement, all items are presented as a percentage of sales. Reviewing the common size income statement focuses on the proportion of sales dollars absorbed by various cost and expense items. Appleseed's cost of goods sold is 34% of sales. Our company's operating expense is 18%, net income is 8%, and so forth. Not bad percentages for a company such as our little enterprise. See Appleseed's common size income statement. Common size balance sheet. To convert the balance sheet into a common size statement, all components are expressed as a percentage of total assets, or total liabilities and equity, since they are the same amount. For example, Appleseed's current assets are 45% of total assets, long-term debt is 26% of total liabilities and equity, and so forth. Common-size balance sheets help focus analysis on the internal structure and allocation of the company's financial resources. Common-size statements are especially useful for the side-by-side analyses of several years of a company's performance, or when two companies of different size are being compared. Appropriate year-to-year questions to ask are, why did we do better last year in this area than we did this year? And how well are we doing when we are compared to other companies in the industry? Liquidity ratios. The so-called liquidity ratios measure the ease with which a company can pay its bills when due. This ability is determined by whether the enterprise has cash in the bank or expects to generate cash by sale of products and by the collection of accounts receivable in sufficient amount to pay its bills as they become due. There are periods of illiquidity in almost every company's life, when the company is unable to pay bills on time. Most often, this situation is infrequent or only temporary, and is usually no major problem. It's happened to all of us at one time or another. However, if a company is illiquid on a regular basis or for a long period of time, it is likely to find itself busted, tapped out, bankrupt. Everyone is interested in Appleseed's ability to pay short-term debts, including its employees, suppliers, and the bank that lent us money for our building. Even our customers care. They need a reliable supply of product. Liquidity and profitability are different. It's possible, and indeed not all that uncommon, for a company to be profitable and illiquid at the same time. A company can show a profit on the income statement and still have very little cash on hand to pay its bills. Profitability coupled with illiquidity can often occur in companies experiencing unexpected high growth. These companies need increased working capital to finance inventories and accounts receivable. Cash can be very tight. Happily, in these conditions, bankers love to lend money to those companies experiencing illiquidity due to rapid, profitable growth. Current ratio. The current ratio is one of the oldest and best-known measures of short-term financial strength. The ratio determines whether current assets, cash or assets that are expected to be converted into cash within a year, are sufficient to pay current liabilities, those obligations that must be paid within 1 year. A current ratio for a general manufacturing company above 2.0 is considered good. It means that the company has twice the amount of current assets as it has current liabilities. A 1-to-1 ratio means that a company can just meet its upcoming bills. With a 2-to-0 ratio or better, there is a big financial cushion. Quick ratio. The quick ratio is an even more conservative measure of liquidity than the current ratio. It is sometimes called the acid test. The quick ratio is the company's quick assets, cash and accounts receivable, divided by current liabilities. Inventories are left out. As shown in the computations here, Appleseed Enterprises is quite liquid. Asset management ratios. Assets are the financial engine of the enterprise. But how do we know that our assets are being used efficiently? Are we getting the biggest bang for our asset buck? Asset management ratios provide a tool to investigate how effective in generating profits is the company's investment in accounts receivables, inventory, and fixed assets. Inventory turn. The inventory turn measures the volume of business that can be conducted with a given investment in inventory. Appleseed turns its inventory 4 times each year. That is, Appleseed needs to maintain an inventory value level of 1/4 of the total cost of its products sold, COGS, in a year. Different types of businesses have dramatically different inventory turns. For example, a supermarket may turn its inventory 12 or more times a year, while a typical manufacturing company turns its inventory twice. Because inventory is built in anticipation of sales, inventory turn is especially sensitive to changes in business activity. If sales slow down, inventory can balloon, and the inventory turn will decrease, a sign of pending trouble. Asset turn ratio. The asset turn ratio is a more general measure of efficient asset use. It shows the sales volume that a company can support with a given level of assets. Companies with low asset turn will require a large amount of capital to generate more sales. Conversely, a high asset turn means that the company can expand sales with a low capital investment. Receivable days. Receivable levels, shown as collection days, is the average length of time the company's accounts receivable are outstanding. That is, how long between when the goods are shipped on credit and when the customer actually pays. Credit sales create accounts receivable, shown in current assets on the balance sheet. These accounts receivable represent future cash inflows into the business. The receivable days ratio, also known as the average collection period, just measures how fast, on average, the company gets this cash. Appleseed's sales terms state net 30. That means that we expect the customer to pay us within 30 days after we ship our applesauce. Appleseed has a receivable days ratio of 54 days. Generally, companies average between 45 and 65 days receivables. Longer could be an indication of bad debts and possible write-offs. Note that if Appleseed could get its customers to pay faster, let's say in 35 days on average, and or if it could get by on less inventory in stock, a higher turn, then a lot of cash would be freed up for other uses. Profitability ratios. Profitability ratios are the common return-on ratios, return on sales, return on assets, and so forth. Profitability ratios relate profits to some other piece of financial information, such as sales, equity, or assets. These ratios measure aspects of management's operating efficiency, that is, management's ability to turn a profit given a level of resources. Although the liquidity measures are most important indicators of short-term corporate health, profitability measures are most important in the long term. In the long term, a business must consistently show a profit to remain viable and to provide its owners with a satisfactory return on their original investment. Return on assets. The return on assets, ROA, ratio measures management's success in employing the company's assets to generate a profit. Return on equity. The return on equity, ROE, ratio measures management's success in maximizing return on the owner's investment. In fact, this ratio is often called return on investment, or ROI. Return on sales. A company's return on sales, also called profit margin, compares what is left over after all expenses and costs are subtracted from sales. Gross margin. A company's gross margin, also called its gross profit, measures how much it costs to make a company's products and, consequently, how much the company can afford to spend in SG&A and still make a profit. Gross margin varies greatly between industries. For example, a retail business generally has a gross profit of around 25%. Computer software businesses can have a gross profit as high as 80% to 90% of sales. That means for every dollar in sales, the computer software company spends only 10 cents to 20 cents to produce its product. Appleseed is doing rather well. An 8% return on sales, profit margin, is good for the industry. A 15% return on equity is fine too. The 8% return on assets is rather low, but not all that bad for Appleseed's first year. Gross margin equals net sales minus COGS divided by net sales equals A plus B divided by A equals $3,055,550 plus $2,005,830 divided by $3,005,560 equals 34%. Leverage ratios. Leverage ratios, also called safety ratios, measure how much of the company's assets are financed with debt. These ratios, 1. Reveal the extent of a company's equity cushion available to absorb losses, and 2. Measure the company's ability to meet its short-term and long-term debt obligations. Leverage is the use of other people's money, OPM, to generate profits for yourself. By substituting debt, other people's money, for equity dollars, your own money, you hope to make more profit per dollar that you invest than if you had provided all the financing yourself. Thus, debt leverages your investment. The leverage ratios measure the extent of this leverage. The reason leverage ratios are also called safety ratios is that too much leverage in a business can be risky, unsafe to lenders. A lender may think of these ratios as safety ratios, while a business owner may think of them as leverage ratios. Use too little financial leverage and the firm is not reaching its maximum profit potential for its investors. On the other hand, too much debt, and the firm may be taking on a high risk of being unable to pay interest and principal if business conditions worsen. Using just the right amount of debt is a management call. Debt-to-equity ratio. This very important ratio shows how much debt the company has relative to its investor equity. Lenders want a low level of debt relative to the company's equity. It gives them comfort that the loan can be repaid even out of shareholders' equity if things go bad for the company. Debt ratio. This ratio measures the amount of debt relative to the total assets of the corporation. The debt ratio is a measure of operating leverage. Appleseed's debt to equity and its debt ratio are relatively conservative for its type of business. Financial ratios by industry. Just looking at a single ratio does not really tell you much about a company. You also need a standard of comparison, a benchmark. There are 3 principal benchmarks used in ratio analysis. Financial ratios can be compared to 1. Ratios of the company in prior years, 2. Ratios of another company in the same industry, and 3. Industry average ratios. History. The first useful benchmark is history. How has the ratio changed over time? Are things getting better or worse for the company? Is gross margin going down, indicating that costs are rising faster than prices can be increased? Are receivable days lengthening, indicating there are payment problems? Competition. The second useful ratio benchmark is comparing a specific company ratio with that of a competitor. For example, if a company has a significantly higher return on assets than a competitor, it strongly suggests that that company manages its resources better. Industry. The third type of benchmark is an industry-wide comparison. Industry-wide average ratios are published and can give an analyst a good starting point in assessing a particular company's financial performance. Mostly, companies in the same industry have similar ratios, financial characteristics of the business that are primarily related to capital needs and available resources. However, some companies do perform better than others, and you can see it in their favorable financial ratios. The table in the bonus PDF shows common ratio averages in various industries and what values are considered better or worse. Favorable liquidity ratios: apparel manufacturing, information technology. Unfavorable liquidity ratios: insurance, software. High liquidity provides flexibility for a business and also makes it possible to ride out hard times. Favorable asset ratios: airlines, retail. Unfavorable asset ratios: pharmaceuticals, telecommunications. Some industries just must use and thus need a lot of capital. Growth could be limited without an easily available capital source. Favorable profitability ratios: software, hotels. Unfavorable profitability ratios: supermarkets, chemicals. There is not much room for error in businesses with low profitability. Companies with high profitability often have proprietary technology that makes it possible to charge high prices. Favorable leverage ratio: software. Unfavorable leverage ratios: supermarkets. Leverage comes with debt. Higher leverage can provide higher profitability, but with high risk. Chapter 14. Alternative accounting policies. Various alternative accounting policies and procedures are completely legal and widely used, but may result in significant differences in the values reported on a company's financial statements. Some people would call this chapter's topic creative accounting. All financial statements are prepared in accordance with generally accepted accounting principles, GAAP. But within these accepted principles are a variety of alternative policies and procedures that may be used. Selection of one policy over another can depend upon management's judgment and upon circumstance. The financial books can look quite different depending upon which policy is chosen. These alternative accounting policies can be used creatively by management as the cosmetics of financial reporting. The table in the bonus PDF shows major alternative accounting policies in use today. Management, with assistance from their auditors, will select from this list of acceptable accounting principles those that best suit their particular enterprise and management philosophy. Generally, the alternative policies can be grouped into two main categories: those that are financially aggressive and those that are financially conservative. Conservative policies. So-called conservative accounting policies tend to understate profits and lower inventory and other asset values. Many accountants think these actions take on a conservative posture for the business. Few expenses are capitalized, that is, A, placing asset value on the balance sheet and amortizing it over time, rather than B, classifying it as an expense immediately. Thus, expenses are higher and profits are lower in the short term, but more solid or conservative in the long term. Aggressive policies. The so-called aggressive accounting policies tend to inflate earnings and raise asset values, thus taking an aggressive financial posture. Reserves and allowances are low, which keeps profits high. These selections of policy can lead to negative surprises, such as if returns or repairs were seriously underestimated. Neither conservative nor aggressive policies are right or wrong. They are just different ways of viewing the same financial information. However, it is important when reviewing financial statements with the purpose of determining a company's financial condition to understand the aggressive or conservative posture the company takes in compiling its books. With conservative accounting policies, you can take comfort that the profits are real. With aggressive policies, profits may be overstated. If, however, you see a company change its accounting policies from conservative to aggressive, watch out. This change may be a sign of big trouble ahead. GAAP does give management latitude to select certain accounting policies and procedures. However, these policies, once selected, must be used consistently, and the year-to-year distortions are usually small. However, in periods of inflation, the difference between common inventory valuation methods can be large. Inventory valuation and costing methods. No, FIFO is not the name of a dog. It's one of the three methods that accountants may use to compute A. Cost of goods sold for the income statement, and B. Inventory value for the balance sheet. Cost of goods sold is most often the single biggest deduction from sales revenue on the way to net profit. How best to value the inventory that makes up this large cost? GAAP offers three basic choices. In an inflationary period, or when costs of raw materials fluctuate, these three methods of inventory valuation will yield considerably different values. The three alternative valuation methods are: average cost method. Under the average cost method, the separate purchases of goods placed into inventory are summed to give the total inventory value and are averaged to give a cost of goods sold value. The average cost method is seldom used, offering no real convenience or added accuracy. FIFO method. Under FIFO, first in, first out methods of valuation, the cost of the earliest materials purchased are assigned to cost of goods sold, and the costs of the more recent purchases are summed and allocated to yield ending inventory values. This method conforms to the actual flow of goods in a factory, with the most recent purchases placed at the back of the fridge, and also the oldest purchases placed in front to use before they spoil. LIFO method. Under the LIFO, last in, first out method, costs of the latest purchases become cost of goods sold, and the costs of the oldest purchases are assigned to inventory. When inventory costs are rising, as in a period of inflation, using the FIFO method means higher profits and higher taxes than if the LIFO method were used. The table in the bonus PDF shows income statement and balance sheet effects of the three alternative inventory valuation and product costing methods in an inflationary period. Depending on the method used, gross profit can vary from a low of $350 with the LIFO method to a high of $500 with the FIFO method. The average cost method is in the middle of the muddle at $425 in gross profit. All are correct values. They just result from applying different acceptable procedures. The table in the bonus PDF summarizes the effects of FIFO and LIFO valuation. While financial statements most often provide accurate, essential information, they do have limitations. 1. Some important corporate assets that are difficult to quantify, valued employees and loyal customers, are disregarded. 2. Only the historic values of tangible assets are presented, not current values. 3. Fallible estimates are made for many important items, such as receivables collection, depreciation, and the saleability of inventory. 4. Profits shown on the income sheet and inventory values shown on the balance sheet can be significantly affected by accounting method choices. Chapter 15. Cooking the Books. The vast majority of audited financial statements are prepared fairly. They are assembled in accordance with GAAP and show sound fiscal controls and integrity of management. However, sometimes this is not the case, and financial fraud is committed and hidden. Illegal payments made, assets misused, losses concealed, expenses underreported, revenue overrecorded, and so forth. The new, shorter Oxford English Dictionary has two definitions for the noun cook. The first describes a person in the white hat behind the counter. The second definition is more appropriate to our discussion: a person who falsifies or concocts something. So the first cook cooks your lunch, the second cook eats your lunch. Cooking the books means intentionally hiding or distorting the real financial performance or actual financial condition of a company. This chapter will give you recipes for book cooking. The goal here is not to make you able to prepare fraudulent financial statements by yourself. Leave this task to trained professionals. Rather, this discussion should make you better able to see the clues of fraud and remind you to be vigilant. Managers most often cook the books for personal financial gain, to justify a bonus, to keep stock prices high and options valuable, or to hide a business's poor performance. The companies most likely to cook their books have weak internal controls and have a management of questionable character facing extreme pressure to perform. Cooking is most often accomplished by moving items that should be on the income statement onto the balance sheet, and sometimes vice versa. A variety of specific techniques can be used to raise or lower income, raise or lower revenue, raise or lower assets and liabilities, and thereby reach whatever felonious objective the business person desires. A simple method is outright lying by making fictitious transactions or ignoring required ones. Cooking the books is very different from creative accounting. It is creative to use accounting rules to best present your company in a favorable financial light. It is legal and accepted. Cooking the books is done for a deceptive purpose and is meant to defraud. Income statement. Puffing up the income statement most often involves reporting some form of bogus sales revenue that results in increased profits. One of the simplest methods of cooking the book is padding the revenue. That is, recording sales before all the conditions required to complete a sale have occurred. The purpose of this action is to inflate sales and associated profits. A particularly creative technique is self-dealings, such as increasing revenue by selling something to yourself. Box A to B. Revenue is appropriately recorded only after all these conditions are met. 1. An order has been received. 2. The actual product has been shipped. 3. There is little risk the customer will not accept the product. 4. No significant additional actions are required by the company. 5. Title has transferred and the purchaser recognizes his responsibility to pay. The other common route to illegal reporting of increased profit is to lower expenses or to fiddle with costs. Box B. A simple method to accomplish this deception involves shifting expenses from one period to another with the objective of reporting increased profits in the earlier period and hoping for the best in the later period. Balance sheet. Most often, both the balance sheet and the income statement are involved in cooking the books. A convenient cooking is exchanging assets with the purpose of inflating the balance sheet and showing a profit on the income statement as well. Box D1A. For example, a company owns an old warehouse valued on the company books at $500,000, its original cost minus years of accumulated depreciation. In fact, the present value of the warehouse, if sold, would be 10 times its book value, or $5 million. The company sells the warehouse, books a $4.5 million profit, and then buys a similar warehouse next door for $5 million. Nothing has really changed. The company still has a warehouse, but the new one is valued on the books at its purchase price of $5 million instead of the lower depreciated cost of the original warehouse. The company has booked a $4.5 million gain, yet it has less cash on hand than it had before this sell-buy transaction. Why would a company exchange one asset for a very similar one, especially if it cost them cash and an unnecessary tax payment? The only real effect of this transaction is the sale of an undervalued asset and booking of a one-time gain. If the company reports this gain as part of operating income, the books have been cooked. Income has been deceptively inflated. If the company purports that this one-time capital gain is reoccurring operating income, it has misrepresented the earning capacity of the enterprise. Question: how many sets of books does a company have? Answer: generally, companies keep 3 different sets of books, each serving a separate and legitimate purpose. 1. One complete set of books for financial reporting to the outside world and to the owners of the business. 2. One modified set of financial statements focusing on determining and defending tax liability. 3. Other special presentation formats of financial information for management to use to control the business operations. Just as some people cheat on their tax returns thinking they will not be caught, some companies cook the books, hoping auditors and regulators will not catch them either. Like borrowing $20 from the till until payday and then not being able to repay the loan, small illegalities can snowball into major fraud. Remember, an auditor's job is only to systematically review the company's accounting and control procedures and then sample its business transactions to see whether appropriate policies and procedures are being followed in practice. But it is quite possible for a dedicated and corrupt management to mask transactions and deceive these auditors. All fast-growing companies must eventually slow down. Managers may be tempted to use accounting gimmicks to give the appearance of continued growth. Managers at weak companies may want to mask how bad things really are. Managers may want that last bonus before bailing out. Maybe there are unpleasant loan covenants that would be triggered but can be avoided by cooking the books. A company can just be sloppy and have poor internal controls. One key to watch for is management changing from a conservative accounting policy to a less conservative one. For example, changing from LIFO to FIFO methods of inventory valuation or from expensing to capitalizing certain marketing expenses, easing of revenue recognition rules, lengthening amortization or depreciation periods. Changes like these should be a red flag. There may be valid reasons for these accounting policy changes, but not many. Be warned. Accounting errors. A step less than fraudulent but still bad is an error of principle, an accounting mistake in which an entry is recorded in the incorrect account, violating the fundamental principles of accounting. An error of principle is a procedural error, meaning that the value recorded was the correct value, but placed incorrectly. An error of principle is different than failing to record the item in question, error of omission, or recording the wrong value in the correct account, error of commission. These errors are referred to as input errors. The complexities of business transactions, along with the human component of accounting, can lead to errors. Discovering these can take some detective work. Some errors can be considered a material error because it can affect how decisions are made. If a company discovers an error after reporting its finances and determines that the error significantly impacts the report, it typically issues a restatement. Section D. Business Expansion, Strategy, Risk, and Capital. About this section. Our startup enterprise has done well. The investors are happy with our progress, and we can feel change jingle in our pockets. Appleseed has become a well-recognized brand name, and the demand for our products is strong. It was not easy to raise the initial capital for our risky startup venture. Nevertheless, Great Aunt Lillian saw our potential, placed a bet, and financed us. Now, even Great Uncle Fred, skeptical before, is happy with their investment. In fact, at the company picnic, he asked me to see him first if we needed money to expand. Yes, we have come to that happy time in the history of a business. Time to ask the questions. Should we expand? And if so, how? The rest of this book will deal with Appleseed Enterprises' rapid growth. Historical versus pro forma financials. Previous chapters show how to report a company's historical financial performance. Now, we are going to look forward and predict the future. We will learn how to analyze alternative investment choices and make plans that will shape our company's future success. In our analysis of future investment alternatives, we will be preparing so-called pro forma financial statements. Pro forma means for form. Pro forma financial statements are in the exact same format as regular historical statements, but are used to model the expected future performance of the company. Pro forma financials, especially pro forma cash flow statements, are useful tools to evaluate the impact of major capital investments by the company. They answer the question, how might our financial future look if we make this investment? Qualitative and quantitative methods. The essence of business is to mobilize capital, money, to generate profit, more money. How successful we are often depends on making good capital investment decisions. In this section, we discuss qualitative tools useful in analyzing business decisions, building decision trees, using strategic planning methods, and understanding risk and uncertainty in any decision. But it takes money to make money, and in the last chapter in this section, Appleseed Enterprises will sell additional equity and take on more debt to finance an aggressive expansion. Then, Section E will focus on the important quantitative tools, net present value, NPV, internal rate of return, IRR, and others, useful in selecting between alternative capital investments. Finally, in Chapter 22, we will take all that we have learned and apply it to Appleseed Enterprises' business expansion. Let's go! We will refocus and reconfirm our mission and vision of the future. We will discuss decision tree analysis, a structured way to assess the alternative pathways for Appleseed's growth. Then, we will select the best path to follow. We will explore the strategic choices a business faces when investing for growth. No matter how good the pro forma financial statements may look, a flawed strategy will lead to failure. We will look at the difference between risk and uncertainty, and how companies can deal with the potential negative consequences of their actions. Finally, confident in our plans and in our future, we will raise capital by adding debt and additional equity to Appleseed Enterprises' balance sheet. The chief determinant of what a company will become is the investments it makes today. The generation and evaluation of creative investment proposals is far too important to be left to financial specialists. Instead, it is the ongoing responsibility of all managers throughout the organization. Professor Robert C. Higgins, University of Washington, in Analysis for Financial Management. Chapter 16. Mission, Vision, Goals, Strategies, Actions, and Tactics. Developing optimal business strategies directed at reaching specific commercial and financial goals is the highest level of planning and command in the organization. We at Appleseed Enterprises are going to make some important decisions. Sometimes deciding what to do is easy. Not much planning, analysis, or consultation is required to pick up a box of cornflakes on the way home from work, and we were running out of 1% milk anyway. However, when a lot is riding on getting a business decision right, it is a good idea to be thoughtful and strategic. But what does strategy mean? How do we develop it? Developing good strategy is a process. We ask some questions, test some assumptions, gather some information, look inward at our strengths and weaknesses, and look outward at our customers and the economic environment. The process is strategic because we seek the best way to respond to our competitive environment given the resources available to us. The process is planning because we set goals and develop structured approaches to reach those goals. Strategic planning is a disciplined effort to produce fundamental decisions and actions that will shape and guide our organization toward our agreed-upon company goals. Strategy is systematically thinking things through and coming up with creative ways to reach business goals. Strategy is of the very highest importance to the success of the business and is thus the responsibility of top-level management. Strategy is always actionable. We plan and execute actions to implement strategy. Strategy is measurable, and thus we will know if it works or not. Strategy is forward thinking. It is not about past actions, but rather about shaping the future. However, strategy must also be in the moment and reflect the current environment facing the business. Strategy is systematic, realistic, and inclusive. Strategy that is creative and unique will be more powerful. Strategy is constrained by the limited resources a company has available, but will optimally use all those available resources. Strategy capitalizes on a company's strengths, but also will support its weaknesses. Okay, got that. Now, let's apply strategic thinking, strategic planning, and strategic management to map a happy future for Appleseed Enterprises. Strategic planning terms. Mission. The word mission comes from the Latin missio, meaning sending away a group to a foreign land and the business with which the group is charged. A company's mission, or mission statement, describes the fundamental purpose of the organization, or why we exist. Vision. The word vision comes from the Old English word vitan, meaning to know, as in the power of anticipating that which will or may come to be. A company's vision is an expression of the business's aspirations going forward, what we desire to become. Goals. The word goal comes from the Middle English word gal, meaning boundary, limit, the end point of a race. A company's goals are the 3 or 4 broad objectives the company sets for itself, the key results to achieve. Strategies. The word strategy comes from the ancient Greek word strategia, meaning office of general, command, generalship, to lead, to conduct. A company's strategies are high-level, long-term plans designed to accomplish specific goals. Each individual company goal may have several strategies required for implementation. Actions. The word action comes from the Latin word acto, meaning doing. Multiple coordinated actions are often required to best implement a strategy. Tactics. The word tactic comes from the Greek word taktikos, meaning fit for arranging or ordering. Tactics are day-to-day tasks that people in the company perform to accomplish an action in support of a strategy. Our plans miscarry because they have no aim. When a man does not know what harbor he is making for, no wind is the right wind. Seneca the Younger, Roman philosopher and playwright, tutor and advisor of Nero. Let's apply these strategic planning terms and definitions to Appleseed Enterprises. Ultimately, we'll answer the all-important question, are we doing the right things to reach our goals? Then we can show our strategic plan to the board of directors to get their comments and sign-off on our plans for the future. After a few meetings of the staff and some market research and then brainstorming sessions, this is what we have. Mission statement. Appleseed Enterprises' mission is to be a leading regional supplier of high-end specialty food products and provide a superior financial return to our shareholders. Vision. Appleseed Enterprises' vision is to be recognized for its delicious and wholesome food products manufactured and marketed in an environmentally friendly manner. Goal 1. Remain the premier supplier of gourmet applesauce in the region. Goal 2. Become a premier supplier of other gourmet food products in the region. Now, both of our goals will need separate strategies to make them real. Each of our strategies will need actions, and actions will need tactics to implement them. At each stage of the pyramid, we will assign responsibility, allocate resources, and measure results as we go forward. Strategic planning is about predicting the future, and predicting the future is an inherently risky business, fraught with uncertainty. We will discuss business risk and uncertainty in the next chapter. There are all sorts of cute techniques to assist managers in understanding their business environment and thinking strategically. Try a SWOT analysis: strengths, weaknesses, opportunities, and threats. A PEST analysis: political, economic, social, and technological, or a STEER analysis: sociocultural, technological, economic, ecological, and regulatory. But don't get too carried away. Chapter 17. Risk and Uncertainty. Appleseed Enterprises is planning for a major expansion. We will soon be making a significant investment with hope for a good return. However, things may go wrong. Ideally, we want a high return but with a manageable and understood risk. That is what we call a business person's risk. Risk. What is risk? Can we understand the risks we face and take actions to lower them? A simple definition of risk is a business event that would generate a negative surprise. A risk is something that we would regret if it occurred. In financial terms, risk is the probability of an investment's actual return being lower than expected. We now have the two elements necessary to start us on a path of business risk management. How can we lower the potential financial downside of risk and/or lower the probability of its occurrence? Risk can be both intrinsic, within ourselves, and extrinsic, from outside. Having to scrap a lot of product because of a quality problem is an intrinsic risk that could lead to very large business losses. A rival company unexpectedly introducing a competitive product that results in our lower sales revenue is an extrinsic risk. If risk is the potential for a business loss, a business project may be deemed a high risk because either A, there is a high likelihood of a loss of any size, or B, there is even a very small likelihood of a large loss. Almost every business action carries some degree of risk. High-risk actions require careful management because of their potential large negative consequences to the business. Uncertainty. Uncertainty is different from risk. Uncertainty is not knowing what the future will bring. However, under the cloak of uncertainty, high risk can lurk. Thus, lowering uncertainty can lower risk too. Uncertainty can be more dangerous than risk. Because we can often know the elements of risk, we can plan for risk and take measures to mitigate the negative consequences of risk. However, with uncertainty, we are often flying blind. It is hard to lower uncertainty if you do not know what it is and thus what to do to lower it. Threat. A threat is a potential event with a very low probability but a high negative impact. People buy insurance to protect themselves against threats such as their house burning down. Businesses can buy fire insurance too, but they cannot insure against an uncollectible debt caused by the business failure of their largest customer. Note that specialized insurance instruments called credit default swaps were developed by the financial services industry to offer some protection against such unlikely negative financial events as failure of a creditor. But as we now know, housing bubble crash, things have not gone very well with this type of insurance. Bet your company risk. Avoid taking a bet your company risk. The potential negative consequences of such a risk are just too large. For example, a bet your company risk would be spending all your available resources on developing a risky new product. The company could fail if development were to be delayed or if sales were much lower than projected. However, entrepreneurial companies usually must face bet your company risks as they start up and grow. Understanding and managing risk and uncertainty is especially important in these fledgling enterprises. Startups must be focused, innovative, responsive, and also very lucky to survive. Most often, they are not that lucky, and they fail. When planning Appleseed's expansion, we recognize that the future is uncertain and that financial projections are just that, projections. Our estimates of what may happen in the future are based on assumptions and on our ability to execute. Assumptions may prove not to be valid, and future performance may not go according to plan. Sigh. The consequences of our actions are so complicated and so diverse that predicting the future is a very difficult business indeed. J.K. Rowling, British fantasy author of Harry Potter and the Prisoner of Azkaban. The best way to predict the future is to invent it. Alan Kay, American computer scientist known for his pioneering work on object-oriented programming and windowing graphical interface design. It's tough making predictions, especially about the future. Attributed to Yogi Berra, American baseball player, actually first said by Niels Bohr, Danish Nobel laureate. Chapter 18. Making Decisions About Appleseed's Future. Appleseed Enterprises' Board of Directors thinks that we can successfully expand our business and that now is a good time to do it. The board has asked management, that's us, to prepare several alternative expansion plans for board review. The most astute member of the board reminds us to think strategically. She recommends writing a strategic plan for the business, and she counsels a judicious look at capital requirements and sources. First, however, we need to make some decisions. Where do we want our company to be in 5 or 10 years? How will we get there from here? What level of risk are we comfortable with? How much money will we need to expand, and where will we get it? What is our plan? Let's generate ideas. Let's brainstorm. Adding a new and complementary product line could be just the thing for us. Our trucks regularly deliver Appleseed's gourmet applesauce to supermarkets and specialty stores around town. Adding more products onto the truck would be easy and economical. Gourmet potato chips would be a nice fit to increase our sales. We could buy that floundering, low-end potato chip company across town, Chips R Us Incorporated, and then rebrand. Alternatively, we could just build a new factory from scratch. Decisions, decisions. The question is how to expand our business. What follows are several useful methods to analyze Appleseed's business expansion opportunities. Decision tree analysis. Building a decision tree is a useful, thoughtful, and structured approach to making business decisions. A decision tree is an easy-to-understand graphic made up of a series of ordered forks, called nodes, that visualize a decision pathway. Drawing a decision tree is useful in arraying all the key alternatives in a business decision. Then just follow the decision tree to a decision. Start at the lower left base of the tree and follow through to each decision node. First, should Appleseed expand or not? Node A. Second, if we do expand, then should we diversify our product line beyond applesauce? Node B. Last, if we were to diversify into, say, potato chips, should we buy an existing company or build a new plant from scratch? Node C. Each fork on the decision tree carries its own benefits and risks, costs, expenses, and revenues. The decision tree structure helps us to systematically review pros and cons at each key stage of our decision. Strategic alternatives. Another way to analyze Appleseed's expansion decision is to prepare a strategic alternatives table. Appleseed could expand by selling new products or by entering new markets or both. These choices result in 4 strategic options. Option 1, same product into the same market. Option 2, new product into the same market. Option 3, same product into a new market. Option 4, new product into a new market. Let's look at each option in detail. Option 1, same product into the same market. This option is the status quo. All growth would come from selling more of our applesauce into our existing markets. Because we want to expand rapidly, this option is not for us. Option 2, new product into the same market. Expanding Appleseed's product line to include gourmet potato chips and selling them through our existing retailers is an attractive and low-risk strategy. We are experts at manufacturing food products, and we understand the needs of our existing customers. Plus, they like us and would be happy to buy more products with our brand name. Option 3, same product into a new market. Selling into a new market could require costly new distribution methods. In addition, penetration would be time-consuming. New markets can be risky. We lack experience with these customers. Option 4, new product into a new market. Simultaneously entering a new market with a new product is perhaps the riskiest of our 4 potential strategies, carrying the uncertainties of both the risks of product development and sales. Overall, Option 2 seems to make the most sense for Appleseed Enterprises Incorporated. Potato chips it is. Make versus buy decision. Now, by expanding into a new product line, we will face a standard make versus buy strategic choice. See Node C on the decision tree. Should we build our gourmet potato chip factory from scratch, or should we buy an existing concern? We hear that a low-end potato chip company across town, Chips R Us Incorporated, is not doing well and may be for sale for the cheap. Purchase alternative. If we were to buy an existing company, we would have to refurbish their equipment to make our high-end product, but the cost would be less than starting from scratch. Chips R Us's capacity is not what we would want in the long term, but would be adequate for a couple of years, and then we could expand. Greenfield alternative. Appleseed could start from scratch and build a new plant on an empty greenfield site with all new machinery. It will take a little longer to get going than if we bought Chips R Us, but the new plant would be perfect. How should we decide whether to build from scratch or make the acquisition? Well, let's prepare some pro forma cash flow statements that will allow us to compare the financial returns of the 2 alternatives under consideration. We will need to consider the dollar amounts and timing of a series of cash investments and the ultimate returns on these investments. In Section E, we will review quantitative tools to help us and the Board of Directors compare the purchase option versus the greenfield option for Appleseed's expansion into potato chip manufacture and sales. Regardless of which option we choose, Appleseed will need more capital to proceed. So, in the next chapter, we will look at available sources and associated costs of new capital. You will either step forward into growth or you will step back into safety. Abraham Maslow, American psychologist noted for his concept of the hierarchy of human needs. Chapter 19. Sources and Costs of Capital. We've decided on an expansion strategy, but Appleseed does not have enough cash on hand to finance either an acquisition or major expansion of its business. However, we do have a very solid balance sheet with a 0.5 debt-to-equity ratio. Total debt is only 1/2 of our equity. Our preliminary analysis of cash flows shows that Appleseed will need $2 million for additional property, plant, and equipment, plus more working capital to finance the expansion. We'll discuss how we prepared these projections in Chapter 22. We are on good terms with the local bank. We could take on additional debt. Also, our venture capital investors have offered to purchase more stock in Appleseed. That is, if the price is right. More debt for Appleseed? Banks will not lend unless they are almost positive that we will be able to repay what we owe. The amount of equity capital, stock, in the business acts as a safety cushion for the bank. The stockholders will lose everything before the bank would lose a penny. In general, debt is a cheap form of financing, if you can get it. So, what will debt financing actually cost Appleseed? Banks set their interest rate on loans with two components. They add the current risk-free lending return from government bonds to a risk premium based on how risky they judge the company to be. For example, if government bonds are yielding 4% and our friendly loan officer sees us as a moderate risk justifying an additional 4% as a risk premium, then our total interest rate will be 8% for a loan. More equity for Appleseed. Early in the book, we asked the question, what's the business worth? The answer was only of academic importance for Appleseed back then. Now things are different, and valuation is important. We want to sell more stock to help finance Appleseed's expansion. But how much stock and at what price? The money raised will be added to Appleseed's balance sheet, and new shares will be issued. We meet with our friendly venture capitalist, and she says, "We like what you have done, and we can support your expansion plans. We're prepared to buy more stock, investing an additional $800,000 at a pre-money valuation of $2.5 million, and thus a post-money valuation of $3.3 million. Say what? Pre-money? Post-money? We mumble, "Thanks, and we'll get back to you." The next step is to crack an entrepreneurial finance textbook to figure out what our friendly VC is talking about. Pre-money valuation. It all turns out to be rather simple. Appleseed currently has 200,000 shares outstanding. We own 50,000 founders' shares that we got for cheap at $1 per share. Our venture investors own 150,000 shares for which they paid $10 per share. Currently, a conservative valuation for the company, based on a 12 times earnings multiple, would be about $3 million, or about $15 per share, computed as a $3 million value divided by 200,000 shares outstanding. This $3 million total value and $15 per share is what is meant as the pre-money valuation of the company, the company's total estimated value before the sale of additional stock. Post-money valuation. We're looking to raise $800,000 in new equity capital. Right after we raise this amount and place it into the company coffers, in our bank account and on the balance sheet, The so-called post-money value of the company will be $3 million pre-money company value plus $800,000 new investment equals $3,800,000 post-money company value. Total pre-money and post-money valuations are intuitive. The post-money value of the company is just the pre-money value plus the amount of new money raised. Now we come to the real point of negotiation with our friendly venture capitalist. How many new shares of stock does she get for investing $800,000 in Appleseed new equity? And then, importantly, how much of the company will we still own after the financing? Dilution. Remember, our Ms. Venture Capitalist has offered us $800,000 in new equity at a pre-money valuation of $2.5 million. We think that her valuation is on the low side and counter with an offer to issue stock with a $3.5 million pre-money valuation. Now, we need to compute how many new shares we would issue to close this deal. We can determine how dilutive this offering will be to our ownership percentage. Dilution means how much less as a percentage of the total company we will own after we issue more shares. Of the current 200,000 shares of stock outstanding for Appleseed, we own 50,000 shares and the venture capitalists own 150,000 shares. Thus, we own 25% of the company and they own 75%. After the company issues more shares to the venture capitalists, we will still own our original 50,000 shares, but they will own 150,000 shares plus however many new shares the company needs to issue to induce the venture capitalists to trade the new stock for $800,000 in capital. The negotiation we are having with our venture capitalist is over what pre-market valuation of the company is to be used in computing the share price of the new offering. Look at the table in the bonus PDF to see how pre-market valuation and the offering share price will affect both our and the venture capitalist's percentage ownership. Note the pre-money share price and the post-money share price are always the same. It's just how the math works. After much toing and froing, we split the value difference and agree on a share price of $15 with a $3 million pre-money valuation of the company. See details of the Deal B in the table. In Transaction 32, we will issue stock and negotiate a line of credit. Cost of equity capital. We know that the additional debt will cost Appleseed interest at an 8% annual rate. But what does selling more equity cost? Well, there is no explicit interest rate attached to common stock, but venture investors do expect a very good return on their investment. Before we closed the deal for the additional expansion equity, we did ask our venture capitalist what return she was expecting. She said she would be happy with a similar return to that received in the original investment. Investors paid $10 per share originally, and we have estimated that the share price has increased to about $15 in 2 years. Therefore, this increase in value represents about a 22.5% annual return. A 22.5% annual return is a lot higher than the 8% interest that the bank requires, but then equity investors are taking a much higher risk. Note that the bank would not have lent us money if we had not raised enough additional equity to keep our debt-to-equity ratio low and lowered the risk that the bank would lose capital if we were to default. Weighted average cost of capital. Most companies have several types and sources of capital. Appleseed has both equity and debt in its capital structure, each costing a different amount. When making capital investment decisions, it is useful to compute the weighted average cost of capital, considering all the capital sources that the company employs. After the financing, 60% of Appleseed's capital is equity with an estimated cost of capital of 22.5%. Further, 40% of Appleseed's capital comes from debt, with half at an interest rate of 10%, mortgage rate from transaction 3 and the other half at 8% for the proposed new line of credit. Note that because interest is tax-deductible as a business expense, the effective cost of debt capital is lower by the 34% expected tax savings. The 10% rate becomes a 6.6% cost. The 8% rate becomes a 5.3% cost. Appleseed's weighted average cost of capital, abbreviated WACC, is calculated by weighting the individual capital source costs by their percentage in the company's total capital structure. Thus, 60% times 22.5% equals 13.5% cost of equity. 21% times 6.6% equals 1.3% mortgage cost. 19% times 5.3% equals 1% credit line cost. 100%, 15.8% WACC. We will hear in the next section that this 15.8% return should be a minimum target for our expansion investments. T32. Finance expansion. Sell 53,333 shares of Appleseed's common stock, $1 par value, for $15 per share, and draw down $100,000 from a new line of credit. This stock sale transaction is similar to that shown in Transaction 1. We have exchanged a percentage ownership in the company for capital. In that transaction, the stock price was only $10 per share, and thus, for every $100,000 we raised, we exchanged 10,000 shares of stock worth almost 5% of the company. Because the stock price is higher now, at $15 per share, we will only transfer 6,666 shares, 2.6% of the company, to raise that same $100,000. Flush with this new equity, and to add some borrowing flexibility, we negotiated a line of credit with the local bank. A line of credit is a flexible, short-term business loan where the bank agrees that Appleseed can borrow a drawdown up to a prearranged maximum loan balance, but only if and when the money is needed. Interest is not charged on the part of the line of credit that is unused, and money is available without having to reapply every time we draw down money from the line. Transaction. Our friendly venture capitalist has happily agreed to finance our expansion into gourmet potato chip manufacture. She purchases 53,333 shares of common stock at $15 per share for a total of $799,995 and throws in a $5 bill to make our accounting easier. Our friendly banker is impressed that we were able to sell more stock and offers us a line of credit that matches the $800,000 additional equity we raised. Interest is paid of 0.666% per month, 8% per year, on the outstanding balance only. We draw down $100,000 to seal the deal. 1A. Issuing stock creates a liability for the company. Appleseed owes the new stockholders a portion of its assets, so increase capital stock on the balance sheet by $800,000. 1B. In the cash flow statement, add the $800,000 from this stock sale to sale of capital stock. 2A. We have established an $800,000 line of credit but have only taken down $100,000 to date. Thus, add this amount to current portion of debt in the liabilities section of the balance sheet. 2B. Add in the cash flow statement this $100,000 as net borrowings. 3. The total of $900,000 in cash received from the stock sales plus new borrowings is added to cash on the balance sheet. Section E. Making good business investment decisions. About this section. Capital investment decisions are among the most important that management can make. Often, capital is a company's scarcest resource, and using our capital wisely is essential for success. capital investments are long-term bets to build a better future. More than any other business action, capital investment decisions will define the company and its ultimate value. Faced with limited capital resources, management must decide which capital projects are economically feasible. Management must select projects that will contribute the most to increasing the company's value. This process of evaluating, comparing, and selecting projects is called capital budgeting. Budgeting. Budget, from the French budget or purse, refers to a list of all planned expenses and revenues. It is a plan for saving and spending. Capital budgeting is a systematic approach to determining whether a company's planned major capital investments are worth pursuing. Capital budgeting is concerned with the justification of capital expenditures. Capital budgeting analysis can provide a rationale to select between alternative projects by answering the question, which proposed project will most increase the company's value over time? This section will introduce you to the quantitative tools necessary to make good capital investment decisions. Then, in the last chapter, Chapter 22, we will apply all this new knowledge to evaluate our expansion plans and to prepare a capital budget for Appleseed Enterprises. Long-term projects usually spend cash, that is, negative cash flow, early in the project's lifetime, and harvest rewards, that is, positive cash flow, later. Different projects can have very different cash flows both in dollar amounts and in timing. To compare project values, we will use numeric techniques that consider the time value of money. First, the analysis requires estimating the size and timing of all incremental cash flows from the project. These future cash flows are then discounted to estimate their present value, PV. These present values, both investments and returns, are then summed to get the so-called net present value, NPV, of the project in today's dollars. NPV is the estimated value added to the company by executing the project. Generally, the project that has the highest NPV is selected to go forward. A discount rate is used in NPV calculations. This rate is like an interest rate, but in reverse. A commonly used discount rate for capital budgeting is the company's weighted average cost of capital, WACC, which considers the company's financing mix. An additional rate increment is added if the project carries a higher risk than that of the company as a whole. This discount rate is sometimes called the hurdle rate, the company's minimum acceptable return on capital invested. It is best to look at quantitative project evaluation tools as just one of several useful decision-making resources. Careful strategy selection, management intuition, and study of historic precedent go well with quantitative measures such as NPV in making capital budget decisions. Just eyeballing a set of numbers provides as much guidance as an overly precise computation, especially when the required input variables are not predictable with much accuracy. Some practitioners have gone so far as to say that most detailed quantitative analysis is not as important as good management judgment and thoughtful strategy. Using both quantitative and qualitative measures is important in making business decisions about the future of the company. However, no matter how good the numbers may look, sound strategies are absolutely essential. No matter how high the computed NPV for a capital project, if the company's basic strategies are defective, the capital project will fail to reach its goals. But beware! Having a quantitative basis for evaluating business decisions can provide objectivity. However, the rigid methodologies used can force potentially flawed assumptions and projections that will compromise the analysis. Just because resultant numbers look precise and accurate does not mean they are meaningful. Don't forget the maxim, garbage in, garbage out. Chapter 20. time value of money. Capital budgeting decisions require analyzing business cash flows, often spanning years. Accounting for the time value of money is essential in these analyses. More on capital budgeting in Chapter 21. A bird in the hand, today, is worth two in the bush, tomorrow. Now you know most of what you need to know about the time value of money. It is intuitive. Everybody would rather have $1 in his or her pocket today than to receive $1 far into the future. Finance types say that today's dollar is worth more, that it has more value than $1 received tomorrow. The rest of this chapter will answer the questions, why so and how much. The three main reasons for this time difference in value are 1. Inflation. Inflation does reduce purchasing power value over time. With 5% per year inflation, $1 received a year from today will only buy 95 cents worth of goods then. 2. Risk. There is always the chance that the promise of $1 in the future will not be met, and you will be out of luck. The risk could be low with a CD at an FDIC-insured bank, or the risk could be high if it is your brother-in-law who is promising to repay a personal loan. 3. Opportunity cost. If you loan your dollar to someone else, you have lost the opportunity to use it yourself for a time. That opportunity has a value to you today that makes today's dollar worth more than tomorrow's. The three concepts, inflation, risk, and opportunity cost, are the drivers of present value, PV, and future value, FV, calculations used in capital budgeting. The mathematics of present value and future value calculations are a bit more difficult than the addition and subtraction we have used in the balance sheet, income statement, and cash flow statement. However, if you only understand the concepts but not all the math, you will still get 95% of the way to understanding. There is a special vocabulary used to discuss capital budgeting and the time value of money. Just as with the three major financial statements, there are new words to learn, or perhaps old words with new, specific meanings. It is a necessary short ride and not all that complex. All will become clear. Trust me. Values, rates, and time. Values are measured in currency. We will use US dollars. Other places use different currency. Some interesting value types are present value, future value, discounted value, terminal value, net present value, and so forth. But note that in financial calculations spanning time, currency value can be looked at from two different perspectives, as so-called nominal dollars or as so-called real dollars. Nominal dollars are just the actual amount spent in dollars taken out of your wallet. Real dollars, on the other hand, are adjusted for inflation. Why bother calculating both? Well, when you take out inflation, that is, convert from nominal dollars into real dollars, the price difference becomes much more comparable and easier to explain. See Appendix A for more details. Present value, PV. Present value calculations are used in business to compare cash flows, cash spent and received, at different times in the future. Converting cash flows into present values puts these different investments and returns onto a common basis and makes capital budgeting analysis more meaningful and useful in decision-making. Rates are measured in percentages and with an associated time period, for example, 5% per year. The period could be a month or a day or even continuous. Some interesting rates are inflation rate, interest rate, discount rate, and hurdle rate. Specialized rates include internal rate of return, risk premium, and return on investment. Details follow. Capital budgeting. In capital budgeting, different projects require different investment and will have different returns over time. In order to compare projects apples to apples and oranges to oranges on a financial basis, we will need to convert their cash flows into a common and comparable form. That common form is present value, PV. Simply put, a little bit of cash that is invested today followed by lots of cash returned soon would be a really good financial investment. However, lots of cash invested today followed by a little bit of cash returned in a long time would be a bad investment. Capital budgeting analysis is as simple as that. All the complex net present value, NPV, and internal rate of return, IRR, calculations are just details. Nevertheless, details can be important. In the next chapter, we will take what we have learned and apply it to understanding net present value, NPV, analysis. It is the most powerful and widely used analytic technique in capital budgeting. Summary: PV and FV. Present value, PV, is the current value of a future sum of money or stream of cash flows given a specified rate of return. Future cash flows are discounted at the discount rate, and the higher the discount rate, the lower the present value of the future cash flows. Determining the appropriate discount rate is the key to properly valuing future cash flows, whether they be earnings or obligations. Present value is the concept that states an amount of money today is worth more than that same amount in the future. In other words, money received in the future is not worth as much as an equal amount received earlier. Money not spent today could be expected to lose value in the future by some implied annual rate, which could be inflation or the rate of return if the money was invested. Calculating present value involves assuming that a specific rate of return could be earned on the funds over the time period. FV calculation allows investors to predict, with varying degrees of accuracy, the amount of profit that can be generated by different investments. The amount of growth generated by holding a given amount of cash will likely be different than if that same amount were invested in stocks, so the FV equation is used to compare multiple options. Determining the FV of an asset can become complicated, depending on the type of asset. In addition, the FV calculation is based on the sometimes invalid assumption of a stable growth rate. If money is placed in a savings account with a guaranteed interest rate, then the FV is easy to determine accurately. However, investments in the stock market or other securities with a more volatile rate of return can present greater difficulty. Equations? The equations in the following sections are not all that daunting, but if you are having trouble, just read the words and try to understand the concepts. The actual manual computations can become cumbersome, but Microsoft Excel spreadsheet functions make computation of PV and FV easy. Later in this chapter, we will describe their use. Present value, PV, and future value, FV. The most commonly applied model of the time value of money is compound interest. Compounding is the process of computing the future value of money you have today given a certain interest rate. Use this formula to determine how much money, FV, future value, you will have in your savings account after Y years if you deposit an amount, PV, present value, now and receive interest at a rate of I per year. FV equals PV times the value 1 plus I to the power of Y. So, if the amount you deposit, PV, is $100, and the interest rate I is 4% per year, and you leave the money in the bank for Y years, 7, you will be able to withdraw a total of $131.59 in 7 years as FV. FV equals $100 times the value 1 plus 0.04 to the 7th power equals $131.59. Now, if you want to compute the present value, PV, of a future value, FV, to be received in Y years using the discount rate of D per year, then you would rearrange the equation as PV equals FV divided by the value 1 plus D to the power of Y. Note, discounting is the process of computing the present value of money to be received in the future. Discounting future project cash flows, future values, into present values will be important when we financially evaluate alternative capital projects. More later. Interest, discounting, and rates. Think of interest as the rent you must pay to borrow and use someone else's money. Interest rates are analogous to miles per hour speed measures. Both interest and speed measures have a numeric amount applied in a unit of time. 60 miles per hour means that if you are traveling at that rate in an hour, you will go 60 miles. An interest rate of 4% per year means that if you deposit $100 in a bank account, you will be able to withdraw $104 in a year or withdraw $132 in 7 years. Discounting is the process of finding the present value today of cash projected to be received at some future date. The projected amount of cash in the future is reduced using a discount rate for each unit of time between now and the future. Got that? Think of discounting as computing interest but going backwards. In discounting, going backwards, you use a discount rate instead of using an interest rate going forward. So, $132 projected to be received 7 years in the future would be discounted back to a value of $100 using a 4% annual discount rate. Both amounts are in nominal dollars, the currency of the day. Computing PV and FV with Excel. Present value, PV, and future value, FV, can be computed using the formulas previously discussed with financial calculators, or most easily with computer spreadsheet applications such as Excel from Microsoft. See the sample spreadsheet in the bonus PDF. Excel has extensive help screens to guide use of financial functions. In the following chapter, we will use the Excel Net Present Value (NPV) function in making capital investment decisions. Chapter 21. Net Present Value, NPV, and Internal Rate of Return, IRR. We're going to invest cash now with high hopes of a large future return. But will the anticipated payback be enough to cover our initial investment given the project's high risk? Further, would any of our alternative projects provide us with a better financial return? Answering these questions is the essence of capital budgeting. Net Present Value (NPV) analysis provides gold standard answers. The NPV of a proposed project is the present value, PV, of future cash flows from the project minus today's value of invested cash. In NPV analysis, relevant cash inflows and outflows are discounted to compute the present value for each and then added. The resultant NPV is an estimate of how much the project will increase the wealth of the company. If NPV is positive, the project will add that value. A project with a negative NPV should seldom be pursued. If we must choose between several project alternatives, the project with the highest NPV will provide the highest value to the company. The higher the NPV, the better. As you will hear in the next few sections, actually computing NPV is a piece of cake. All the heavy lifting is done by computer spreadsheets. The hardest part of an NPV analysis is estimating the right cash flows to use in the formulas. The very foundation of NPV analysis is the accurate forecasting of cash flows associated with a capital project. These pro forma cash flow projections answer the questions: what initial investment will be required for this project, and then how will this project impact the company's future total cash flows? But beware, application of these concepts and formulas without understanding their limits will often lead to erroneous and misleading results. Also, the mistaken impression of accuracy given by computation of seemingly overly precise variables can give a false confidence in pro forma projections. And don't forget strategy. No matter how high an NPV, if a company's strategies are defective, its capital investment projects will most likely fail. Later in the chapter, we'll discuss other analysis techniques used in capital budgeting, including IRR, ROI, and payback period. But most often, all you will need is NPV. In the next chapter, we will apply NPV analysis to our planned business expansion at Appleseed Enterprises. Cash flow forecasting. Accurately estimating the amounts and timing of all the project cash inflows and outflows can be tricky. Forecasting cash flows requires a detailed understanding of the business and the project being analyzed, its input variables, and expected outcomes. We must estimate the amount and timing of original investments, changes in working capital, and in ongoing costs and expenses. We must understand customers' needs and wants and market conditions to properly forecast revenues. In addition, current and future financial environment, expected rates of inflation, project risk, and tax considerations each play a part in NPV computations. Moreover, each of these elements of cash flow must be sequenced so that the NPV analysis will properly account for the time value of money. It is a lot to ask. Selecting a discount rate. Selecting the appropriate discount rate is also difficult. The minimum discount rate would be equal to the company's weighted average cost of capital. Any project must return that amount or it will dilute the value of the company. Then, a risk premium should be added if there is increased risk in the project relative to the inherent risk associated with the company's overall business. Venture capitalists add a risk premium of 30% or more to startup company projects. A modest risk premium of 5% to 15% might be more appropriate for an expansion project for an established company. Developing an NPV versus discount rate analysis may be helpful. Our advice: beware of geeks bearing formulas. Warren Buffett, commenting on financial models and the financial collapse of 2008. Sensitivity analysis. Not all the input variables in a capital budgeting analysis are equally important. For example, sales forecasts are almost always critical variables. Costs, plus or minus 10% for a high gross profit product, may not be all that important. Performing a sensitivity analysis can help identify the key variables in a capital budgeting analysis. In a sensitivity analysis, variables are systematically changed to see how the resultant NPV or IRR is affected. If changing an assumption results in a big change in the computed project value, then it is an important variable to get right. If changing an assumption results in just a small change, then it is less important. In scenario analysis, you might want to look at all your financial assumptions from a conservative perspective and see how cash flows are affected. For example, assume that everything will cost more and take longer to accomplish than your original projections. Often, it is useful to prepare 3 sets of pro forma statements, one with conservative, pessimistic assumptions, one with realistic assumptions, most probable, and one with optimistic assumptions. NPV guidelines. Here are some operating guidelines for cash flow forecasting and NPV analysis. 1. Cash flow forecasting. The total cash flows used in NPV analysis should come from well-prepared pro forma financial statements developed for the project. 2. Count all incremental cash flows. Incremental cash flows are those that arise from the project, from sales, costs, expenses, capital investment, increase in working capital, or other sources. Opportunity costs count too. If an existing asset or employee will be part of the project, then these costs should be included in the project's cash flow. 3. Count only incremental cash flows. Don't include sunk costs. We have already spent that money, and they should not be a part of the forward-looking decision process. Accounting conventions used in balance sheet and income statement construction can mask the value of a project. Cash flow and profits are not the same. Being profitable does not necessarily mean the project has a positive cash flow. 4. Use nominal dollars in cash flow projections. A portion of the selected discount rate used in NPV calculations accounts for inflation. We must use nominal dollars in our forecasts so as not to double count. See Appendix B, Nominal versus Real Dollars. 5. Account for time. Capital budgets often show initial cash outflow, the investment, and then a future cash inflow, the return. When analyzing cash flow, take into account that a dollar spent today is worth more than a dollar received in the distant future. The discounted value of a future cash flow is determined by reducing its value by the appropriate discount rate for each unit of time, period, between when the cash flow is to be valued and the actual time of the cash flow in the future. 6. Don't include costs of financing. In capital budgeting, the costs of financing should not be in the cash flow projections. Remember, part of the discount rate used in NPV computations includes a cost of capital estimate. 7. Account for risk. Not all projects have the same risk. A project that is riskier should generate a higher expected return. A portion of the discount rate used in NPV computation deals with risk degree. 8. Understand assumptions. Numeric tools used to evaluate capital projects often can provide valuable insights, but, misapplied, they are worthless. Understand the assumptions upon which these calculations rest. Microsoft Excel makes the computation part of NPV and IRR analysis easy. However, estimating cash flows and NPV discount rates can still be problematic. Nevertheless, using spreadsheet functions to perform sensitivity analyses quickly on key variables can greatly add to the value of analyses. Using spreadsheets. To compute NPV or IRR, the cash flow inputs are entered as an array, a sequence of spreadsheet cells, and the financial functions are computed using the formulas shown here. Be sure to review all the help screens available for each function to understand their application. NPV. Rate, value 1, value 2, etc. Rate means the selected discount rate over one period. Value represents the array of each cash outflow or cash inflow equally spaced at the end of each period. IRR. Values, guess. Values represents an array of cells that contain the numbers for which you want to calculate the IRR. The optional guess input is an estimate of the resultant IRR. The spreadsheet uses an iterative technique starting with the guess to calculate the IRR. Other spreadsheet functions are available for modified internal rate of return (MIRR) calculations using a lower discount rate for cash inflows and also for calculations to be used with projects with irregular cash flows XNPV and XIRR. Net Present Value, NPV, formula. The net present value, NPV, of a proposed project is the sum of all the project's projected cash flows over time discounted by an appropriate rate to bring them to a present value. If the NPV of a project is positive, the project is projected to increase the value of the business by that amount. Shown in the bonus PDF is an annotated version of the standard net present value, NPV, equation. It is not very daunting once you get the hang of the concepts and work through some. Anyway, spreadsheets will do all the heavy lifting. Internal Rate of Return, IRR. The internal rate of return of a project is the discount rate that makes the present value of future cash flows equal to the initial investment. Thus, the IRR is that point where NPV equals $0. A project's NPV is higher when using a low discount rate because the computed value of future cash flows is higher if discounted less. A project's NPV is lower when using a high discount rate because the computed value of future cash flows is lower if discounted more. See the net present values at different discount rates graph in the bonus PDF. Using a discount rate of 12%, we computed NPV equals $257 for our sample project. With a 5% discount rate, the NPV would be over $400. With a 35% discount rate, the NPV would be negative. The project would cost us more than it would bring in. The IRR in this example is 30%, where NPV equals 0. IRR is often misunderstood as the annual profitability of the project investment. This level of return is only if cash flows from the project can be invested at the same rate as the IRR. Seldom the case. NPV versus IRR. NPV and IRR measure two different but complementary aspects of capital use. The two methods of evaluating capital investments each have inherent advantages and disadvantages. Net present value, NPV, versus internal rate of return, IRR, in capital budgeting. NPV advantages. NPV is a direct measure of expected value added to the company from executing the project. Comparing the value of alternative projects is easy with NPV analysis. Just pick the project with the highest NPV. NPV disadvantages. NPV requires an assumed input discount rate, capital cost plus risk premium, which may be difficult to estimate. IRR advantages. IRR is a popular capital budgeting tool because it shows the efficiency of capital use in an easy-to-understand percent return format. Computing IRR is valid without having to estimate a discount rate. IRR disadvantages. IRR computes only a percent return, not a value, and thus disregards project scale and is not a measure of ultimate worth to the company. IRR can make a small project appear more attractive than a large project. In fact, a very small project could have a very high IRR, but also have a low and very unattractive NPV. IRR assumes cash flow returns are invested at an often unrealistically high rate, the IRR. MIRR, Modified Internal Rate of Return analysis, solves this problem. Other measures. Finance types regard NPV as the all-around best measure of value added from a capital project, but there is also a place for IRR in determining how efficiently capital is employed. NPV and IRR measure two different complementary aspects of capital use. NPV and IRR can be used together in making capital budgeting decisions. What follows are other common capital budgeting techniques, some with flaws, others helpful but complex. Return on investment, ROI. There is no way of computing ROI. Many organizations use ROI to mean several different analytical techniques. Thus, ROI measurement is flexible but also subject to confusion. Use the well-defined NPV and IRR instead. Payback period. Payback period refers to the period required for the return on an investment to repay the sum of the original investment. Shorter payback periods are obviously preferable to longer payback periods, assuming all else being equal. Payback period as a measurement is easy to compute and is intuitively understandable. However, payback period computations ignore the time value of money and ignore any cash flows occurring after the payback period ends. As a method of capital budgeting analysis, payback period has serious limitations. Real option analysis. Real option analysis allows for go, no-go decisions during a project. The flexibility to slow down or to even stop a project if necessary lowers risk to the company. This lowered risk adds initial value to the project over another project that could not be stopped. Real option analysis can be quite complex, but is very useful for large capital projects. Monte Carlo analysis. A Monte Carlo analysis is a complex multivariable NPV calculation that first assigns various probability values to capital project variables and then simulates many outcomes using the brute force of computing power. The Monte Carlo analysis output is a probability distribution histogram showing the volatility and sensitivity in a project's NPV. It is a very powerful technique, but requires sophistication to apply. Summary. Generally, when comparing projects, the project with the highest NPV should be accepted. The IRR of the project is the discount rate where the NPV equals 0 and the discounted costs of the project equal discounted returns. Generally, if a project's IRR is greater than the company's hurdle rate, it should be accepted. Capital budgeting using NPV and IRR measures allows management to select rationally from alternative projects with very different cash flows. Different capital projects have different cash flows in both dollar amounts and time. NPV analysis makes comparing the financial worth of alternative projects possible in a standardized way. NPV accounts for the time value of money by calculating the present value of future project cash flows. NPV is a direct measure of expected value added to the company from executing the capital project. Chapter 22. Making good capital investment decisions. At the last board meeting, our esteemed directors approved Appleseed's plans for a major product line expansion into gourmet potato chips. Now we are weighing two alternative capital projects designed to meet that goal. 1. Greenfield option, building a new plant from scratch, or 2. Purchase option, acquiring an existing business, Chips R Us Incorporated. In this chapter, we'll prepare a cash flow forecast for both alternatives and then perform an NPV analysis to help us select the best capital project for Appleseed going forward. Projecting sales. Projecting sales is a good place to start when preparing a cash flow forecast. So here we go. Appleseed's purchase of Chips R Us would allow us to continue selling their low-end branded product while we start up our gourmet potato chip product line. Alternatively, if we build a potato chip plant from scratch, we won't be selling anything for a year or so. The profitability of the current Chips R Us brand is lower than what we expect to receive from our new gourmet potato chips, but at least we would be receiving some income while we launch our own branded product. Now that we have sales forecasts, Let's estimate cash flows for the two alternative capital projects. Estimating cash flows. Cash flow forecasts are constructed from estimates of three major cash-using and cash-generating business elements. 1. Cash from operations. 2. Capital spending. And 3. Increase in working capital. The following section details cash flow forecasts for Appleseed's alternative capital projects. Here is how we arrived at these numbers. Cash from operations. Estimating the cash from operations begins with preparing pro forma income statements for each of the years being analyzed. We start by projecting incremental sales expected from the capital project and then match those sales with the incremental costs and expenses necessary to generate those sales. These costs and expenses are then subtracted from sales. Note, we must add back the depreciation charges since these charges are included as a cost in the income statement, but do not lower cash in the period. Finally, we will subtract any taxes paid, thus yielding an estimated cash from operations for each year. Capital spending. Next, we must estimate for both capital projects the amount and timing of cash to be invested in property, plant, and equipment. With the greenfield options, we will have large capital expenditures for land, a new building, and new machinery. If we purchase Chips R Us, we will need capital to refurbish both the plant and old machinery to bring them up to our high standards. Also, we will purchase additional potato chip making machines to expand Chips R Us's production capacity. The costs to buy land and construct a new building will be high in the greenfield option. Purchasing Chips R Us is less expensive, but their existing factory will need extensive refurbishment. Increases in working capital. Now, we need to forecast the additional working capital, primarily accounts receivable and inventory, required to support our expanded business. It takes money to make money, and the more we sell, the more working capital we will need. Because purchasing Chips R Us will result in earlier and higher sales, we will need more early working capital with that alternative capital project. There is one last but very important projection we must make before we compute NPV: the terminal value of both our proposed capital projects. Terminal value. Forecasting cash flows beyond a certain period is often too uncertain and impractical for an NPV analysis. So, terminal values are often added to the last year's cash flow forecast to estimate and account for the long-term value of the capital project as an ongoing business. The terminal value can be thought of as the price of the whole capital project's business if it were sold as an ongoing concern. Note that for many projects, the terminal value can be a major part of the value added by the whole project, especially when starting a new business or making a major business expansion. In our NPV comparisons, we have estimated terminal values conservatively at 8 times the projected after-tax income for each expansion alternative. Note that although the terminal values are large for both alternatives, the amount received is projected 7 years out in our analysis and thus is highly discounted. The amount is still significant, but not so overwhelming. Computing NPV and IRR. We've carefully projected cash flows for both of Appleseed's expansion alternatives. Now we must select a discount rate before we can perform NPV computations. Neither the purchase option nor the greenfield option seems riskier than the other. Also, neither would add a significantly greater risk to our business than what we already have. Thus, using Appleseed's average weighted cost of capital, WACC, of 15.8% seems reasonable for our NPV comparison. The next step is for us to go to the computer, feed the numbers into an Excel spreadsheet, and let the electrons fly. Voila! The table in the bonus PDF summarizes the results of our comparative cash flow forecasts and NPV calculations. Our computed NPV of the purchase alternative capital project is significantly higher than that of the greenfield alternative. The IRR is higher for the Chips R Us purchase as well. Further, the amount of cash we will need at one time, lowest cumulative cash, is significantly lower for the purchase alternative than for the greenfield option. Capital spending is about the same, plus or minus 10% or so. Financially, the purchase of Chips R Us makes the most sense for Appleseed's expansion into the potato chip market. Note that even though the greenfield alternative only has an NPV of $148,000, it still would have been an attractive project and would return value to Appleseed. However, because the purchase alternative offers the higher NPV of $1,034,000, it makes good financial sense to choose that alternative. We present our NPV and IRR analysis to Appleseed's board, and they agree that purchasing Chips R Us is the way to go. I call Chips R Us's owner and invite him to dinner to finalize the negotiations. We don't go to a fancy place because I don't want him to think we have a lot of money to spend. Over dinner, we settle on a price of $1.25 million, just as we have projected in our NPV analysis. We will only be purchasing assets, leaving Chips R Us liabilities for them to liquidate. I call our lawyers and ask them to work on the purchase and sale agreement. Then I call our accountant and ask her the best way for Appleseed to book this acquisition. She mumbles something about new regulations that she needs to review and says she'll get back to us on FASB Rule 141R. Acquisition Accounting. FASB has regulations to be used in accounting for business combination. In 2009, they promulgated new rules, the so-called acquisition method of business combination. So that's what we will use to account for Appleseed's legal takeover of Chips R Us. Using this acquisition method, all the acquired tangible assets of Chips R Us will be recorded on Appleseed's books at fair market value on the date we acquire them. Fair market value is defined by FASB as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measured date. We are going to have an appraiser come out and value the land, factory, and equipment we will be purchasing. The inventory value we can figure out ourselves. Also, there will be significant one-time legal and accounting fees associated with the acquisition. These additional acquisition expenses will be run through the income statement as incurred. Most of the assets we are purchasing from Chips R Us are tangible bricks and mortar assets, which are easy to value. But we are also purchasing intangible assets, such as customer lists, trade names, supply contracts, trade secrets, recipes for potato chip making, and such. Hard to quantify directly, but FASB Rule 141R shows how. Any excess we pay for Chips R Us over and above the fair market value of net assets recorded on our balance sheet will be reported as goodwill. Goodwill will just sit on our books until it is impaired and no longer valuable. Then we will have to write it off, amortize through the income statement, and take a loss for the amount. Note that amortization of intangible assets is similar to the process of depreciation for tangible assets, written off each year according to a formula. Transaction 33 in the bonus PDF completes our acquisition of Chips R Us and starts Appleseed on its great adventure as a larger business. With the addition of potato chips to our applesauce product offering, perhaps we should change our name from Appleseed Enterprises Incorporated to something a little more flashy, like Amalgamated Gourmet Food Products Corporation, AGFPC for short. What do you think? T33. Buy Chips R Us Incorporated's assets and treat this business combination as an acquisition under FASB Rule 141R. We've done it! Chips R Us is ours! But after the euphoria subsides, we realize that there is a lot of work to do. As a good start, let's adjust the books to account for this momentous purchase. Then we'll drive over to our new plant and begin to learn how to make the world's best potato chips. Transaction: purchase certain assets of Chips R Us for $1.25 million and combine the business into our financial statements as an acquisition as per FASB Rule 141R. The appraised fair market value of the purchased assets is $1.20 million, leaving a $50,000 balance as the intangible asset, goodwill. Write a check to the owners of Chips R Us for $1.25 million. Receive from our appraiser, lawyers, and accountants bills totaling $35,000 for professional services performed on our behalf. Gasp. 1A. Record the $1.25 million payment as a PP&E purchase in the cash flow statement, and 1B. Lower cash by that amount on the balance sheet. 1C. Add the $1.2 million appraised value of the purchased assets to fixed assets at cost on the balance sheet. 1D. Finally, add the remaining $50,000 spent to other assets on the balance sheet as goodwill. 2A. Charge general and administrative expense in the income statement for $35,000 for the professional services bills, and also 2B. Add that amount to accounts payable in the liabilities section of the balance sheet. 2C. This expense has lowered net income, so subtract that amount from retained earnings as well. From the management, that is, the author. It has been a pleasure navigating the financial statements of our company, Appleseed Enterprises Incorporated, with you. Mail us at info@mercurygroup.com with any comments, questions, corrections, or just to say hello. We promise to answer every one. Conclusion. We've come a long way. Our fears of both accounting and financial reporting have melted away. We've learned the vocabulary. We've learned the structure. We know what FASB means, and we appreciate the importance of GAAP. Your goal was to gain knowledge of accounting and finance, to assist you in your business dealings. You wanted the power that comes from understanding financial manipulations. You have done it. I was happy to help, but you did all the work, the heavy lifting. You now understand how an enterprise can be rapidly growing, highly profitable, and out of money all at the same time, and why this state of affairs is fairly common. That accrual has nothing to do with the Wicked Witch of the West. When in the course of business affairs, a negative cash flow is a sign of good things happening, and when it's a sign of impending catastrophe. How discounts drop right to the bottom line as lost profits, and why they are so very dangerous to a company's financial health. The important difference between liquidity and profitability. Those expenditures that are costs and those that are expenses. Depreciation's differing effect on income and on cash. Why product cost always depends on volume. Limits of the common costing systems, and when to apply, and more importantly, when to ignore the accountant's definition of cost. 3 common and different definitions of what a business is worth. Why assets must always equal liabilities plus shareholders' equity, worth, on the balance sheet. Why working capital is important, and what business actions lead to more, and what actions lead to less. The difference between cash in the bank and profit on the bottom line, and how the two are interrelated. How many sets of books a company actually keeps. Why some qualitative business analysis tools are as important as the numbers. the difference between risk and uncertainty, and, which is worse, the difference between pre-money and post-money company valuations when you sell stock. Why $1 in your pocket today can be worth a lot more than $1 received tomorrow. Why a development investment made today must return a much greater sum to the coffers of the company in later years. Which business financing is more expensive, equity or debt? The necessity and limitation of forecasting cash flows over time when making capital investment decisions. When to use NPV analysis and when to use IRR, and why it is important in capital investment decision-making, and more. We have come a long way. We can appreciate my young accountant's poetic remark, "It's just so symmetrical, so logical, so beautiful, and it always comes out right." It always comes out right. Congratulations! You have learned just enough about accounting and financial reporting to speak the language and understand the numbers of business.